Mic check. Mic check.
Should I try to turn it a little lower again?
I don't know, because we already.
Hey, what's going on?
1, 2, 3. Mic check. Mic check. 1, 2, 3.
Good morning, good morning, good morning. Thumbs up. We're gonna leave it that way. It's early. I know there's happy hours. Y'all are the good ones that are here, ready to rock. Ready to learn about fundraising. Who's an entrepreneur in the crowd? Hell yeah. That was pretty much everyone. Any investors here looking for deals? I am. Awesome. Well, good morning. Welcome to the fundraising track. We got a bunch of awesome sessions, incredible guests lined up for you this morning. We're going to kick it off with Gordon's Founders Academy here in a second. But before we do, I want to welcome Dan Austin from Perkins Coie to the stage, who made this whole program possible. Welcome, Dan.
Thanks, Nick. Wow, you were right. This is loud. How many of you are based in Austin? Just sort of curious. All right, got it. How many outside of Texas? All right, well, welcome to Texas. Hopefully you get some good food while you're here. Well, I'm Dan Austin. I didn't change my name when I moved to Austin. I was actually born that way. I'm a partner at the law firm Perkins Coie. For those of you who are not familiar, Perkins is a global AM Law 50 firm. We work with companies, we do business law, we do all kinds of law, we're full service, but we work with companies from, like 2 kids starting a company at UT to Fortune 10 companies and everybody in between. We really help folks along their entire life cycle. It's a lot of fun. I'm a partner in the Emerging Companies and Venture Capital Practice Group, so I get to do that on a daily basis. Super happy and excited to sponsor this track. We always love the fundraising track. Always brings out just such a fun crowd, fun speakers. And as Nick said, I mean, there's a really great, exciting day set up for you. So without further ado, I'm going to hand it back to Nick, and I'll see you later. So I've got a panel that we're going to do at 2:30. We're going to talk about investing in AI. So hopefully we'll see you all back then.
All right, thank you, Dan. All right, we're gonna rock and roll, dive straight into the fundamentals of fundraising with someone who's helped hundreds of companies raise money, doing it the right way. Someone I witnessed raise gobs of money, actually, even in the last year or two. I don't know how much he'll get into it, but it's been pretty exciting at Capital Factory. So we're gonna be joined by Gordon Doherty. He's the best-selling author of Startup Success, seasoned investor behind 500 startup deals, for a masterclass in early-stage fundraising today. We're going to learn how to structure your first raise, choose the right funding vehicles, and avoid common pitfalls that can cost you equity and momentum. So without further ado, let's welcome Gordon to the stage.
All right. Thank you, Nick. All right, get my slides going. All right, welcome back. Well, actually, how many of you were with me yesterday? Raise your hands. Okay, about 80%. Those of you that were with me yesterday might remember that yesterday stood to be a really great day for me. Well, it didn't happen yesterday, but it did happen this morning at about 5:30 in the morning, so, yeah. For those of you that weren't here yesterday, yes, that's my 4th grandchild, my 2nd grandson, and if you didn't notice, what a fine and handy middle name on that young man. I joked to my wife that the reason he looks like he's pouting is because he wanted to see his grandpa when he came into this world, and I couldn't be there. Anyway, so thanks for joining me. As Nick said, thank you. Thanks to those of you, and congrats to those of you that engaged me already to practice your elevator pitch. Those of you that were with me, there was at least a half a dozen that found me in between the bathroom and getting my way back here. Congratulations on that, by the way. At the end of today, there's more elevator pitch practices that could happen right here. Those of you that were with me, remember I challenged you to take it out on a test drive? Well, guess what? The person sitting next to you or in front or behind you would be perfect. They don't know you, they don't know what you're working on, but they actually know the exercise if they were here yesterday, right? This is a perfect, perfect environment to knock out 2 or 3 of those. Thanks for the social media shout-outs yesterday. Tag Capital Factory, you can tag me, tag Austin Tech Week. It's really great, helps us, boost everything that's going on here, makes me feel good. And usually when people shout out, they shout out something that was an aha moment, which is really good for me. Like, what resonated with you enough that caused you to go, oh man, Gordon, that thing that you said about, that was cool, right? It's helpful and rewarding to me. So, okay, so today's all about fundraising. How many of you are fundraising or will be pretty soon? Okay, so it's about a third, a half of the audience. The others of you, I'm assuming you're here to learn, to figure out, do I need to fundraise? And if I ever do, how would I go about doing that, right? So I wrote a book on this. It's called Startup Success, Funding the Early Stages. Somehow it made the bestseller list on Amazon for a while. But it's kind of it's a how-to book. I mean, it really is. It explains the concepts. I really try to demystify a lot of complicating topics. If you don't already have it, we happen to sell it in the Capital Factory store right next door, the gift shop right next door. Has it. A couple of you have already asked me to sign it. Of course, I'm honored if you'd like me to deface your book with my signature. But I wanted you to know about that. The reason some of the chapters are bolded in blue is I wanted you to know those are the chapters I'm going to pull from today. So for those of you that have my book, you're going to hear me talk about some of the most important concepts in those chapters. We only have an hour, so I can't cover the whole book, but I'm going to try and cover some of the most important points. For those of you that weren't with me yesterday, I have an opportunity to answer some questions after each lecture. I think there's 3 lectures here, if I'm not mistaken. At the end, I'm going to pause. I can take 2 or 3 or 4. It depends on how we're tracking on time. I'm going to try and keep us tracking on time. If things work the way I'm hoping, we'll have a good 10 minutes at the end to just really open it up for more questions. And then at the end, when I'm done, I'm going to close my laptop and try and escape this room because they need to flip it for the next session, which starts about 15 minutes after. And so my escape is only going to be to the lobby. So if you need to follow me to the lobby and ask me, a question that's unique to your startup, or if we ran out of time for questions, that's another chance to get with me, okay? Then I'm going to go upstairs to the 16th floor and continue my Austin Tech Week journey. Fair enough? Everybody okay to get started? Anything I need to answer before we do? Okay. If you're going to fundraise, the first thing you need to figure out is when should you fundraise and how much should you raise? It sounds pretty simple, but actually you'd be surprised how many founders that I ask, well, why are you raising? And they'll say something like, well, everybody else seems to be raising funding at this similar stage. And I might say, okay, well, how much are you raising? And they'll tell me the amount, and I'll say, well, why is that the right amount? Well, they give me a reason that I'm gonna share with you some of the most common reasons. It's actually a little more involved than you might think, and I want to explain this to you. I told you yesterday that founders only raise money for one of 2 reasons. They either want the money or they need the money. Most founders need the money, means if they don't, their bank account goes to 0 and they have to pack up their toys and go home, and that's not fun. If you're fortunate, you're either in a position or eventually you will reach a position of raising funding because you want it, not because you desperately need it. Want it means I don't have to have it, but if I had more money, I could grab my gear shift and not just barely go from 1st to 2nd gear. I could go 1st to 3rd or 4th gear. I can accomplish a lot more faster. And I hope that some of you will enjoy being in that mode. Most of you won't be for a period of time. So I want to share with you my magic formula for fundraising. It's going to sound simple, but I'm hopefully going to twist it and deliver an aha moment here in a couple minutes. If you raise money, hopefully you will agree that you will gain time and resources. Time means, we call it runway. You will gain more time before the bank account hits 0. And in our world, we call that runway. How much runway do you have? Oh, 8 months, a year and a half. So if you raise funding, you will gain new time. And you should be able to gain some additional resources. Resources obviously are people that you could hire, but it's also other resources. It's that CNC machine that you need to go buy or some piece of complicated equipment. It's spending money on marketing when you couldn't spend money on marketing before. Like, those are resources, right? So money affords you a combination of time and resources, and if you have time and resources, hopefully you'll agree, you can accomplish things. And I'll call those accomplishments outcomes, because I'm focused on the outcomes type of accomplishment. So money yields time and resources yields outcomes over time, right? Those outcomes happen over time, and I'm interested in the outcomes that occur until you run out of money again, right? I'm looking out into the future. So I'll often ask a founder that tells me, hey, we're raising $500,000 in our seed round, and I'll say, well, awesome, why are you raising $500,000? And they'll often give me answers like, well, I see a lot of other startups like us that are raising $500,000 for their seed round. Could be true. Well, Gordon, $500,000 would let us hire, and then they'll tell me who they're going to go hire. Okay, true. $500,000 at the valuation we're hoping for, it would only dilute us 25%, and we really hate dilution, so 25% would be acceptable. Well, okay, true. Or the one that happens all the time is they'll tell me how much runway it gives them. Well, $500,000 would give us 9 months of runway. I hate that one, the worst of all of them. Like, okay, so I give you money and you get to live for another 9 months? Like, that's not very exciting. So this founder might catch themselves and they go, oops, crap, can I try again, Gordon? I went through your Founders Academy, can I get a do-over? Like, yeah, you get a do-over. $500,000 lets us acquire our next 100 customers and reach 100K in MRR, and along the way, we're going to develop a new version of our product that we can sell for 3 times the price and get a payback against our customer acquisition cost in just 4 months. Do you see the dramatic difference between those two? The biggest difference that you should see is this second response focused on the outcomes, on the accomplishments that the money is going to afford this founder. The reason this is so important is it aligns with one of my very favorite fundraising phrases: investors write checks for outcomes, not activities. Yes, it's true that you get to live 9 months. Yes, it's true that you get to go hire 3 new software developers. Yes, it's true that you get to crank up your marketing spend. Yes, you get to move into a fancy new office. Yes, you get to go buy a CNC machine. Those are activities. Investors care about what outcomes those activities are going to deliver. Investors write checks for acquiring customers, reaching interesting revenue milestones, reaching profitability, landing a significant new partnership, gaining 5 new patents that get awarded, finishing your second phase of your clinical trial so that you can then move into the final phase. Those are outcomes. Those are accomplishments. That is what we care about first. So that's what we want to hear out of your mouths first. It's the reason why the last slide in your fundraising pitch deck that we call the ask slide, what are you asking for? You're asking for money. So at the top it says, so we're raising $2 million seed round. Do not put bullet points on that slide that come from the right side of this slide. We're raising $2 million to go hire 5 engineers and the only thing that should be on that slide is we're raising $2 million in our seed round to accomplish A, B, and C. And the A, B, and C should be the things that get the investor excited. I'm going to double click on that in just a second. It's not that the things on the right are unimportant. The things on the right are the answer to my question, wow, 2 million, you can accomplish those things? How are you going to do that? How is it that you're going to reach 100K in MRR? How are you going to develop? Now you get to tell me the things on the right. You see the dramatic difference? In your brain, usually the front and center in your brain is how you're going to spend the money. God, once this 2 million hits my bank account, I'm going to go hire those 3 engineers. I'm going to move into that office. I'm going to get that CNC machine. Boom, boom, boom. And that's what you're thinking about. The investor's thinking about what's really important, which is the outcomes. Why am I stressing this so much? is because most of you, if you're working on a venture fundable business, at this moment will not, I say this moment, 2025, will not be able to become self-sufficient, sustainable, and scalable with just one round of funding. You'll need another one. So this round of funding should set you up for the next round of funding. I know I told you yesterday that my most recent article is titled Building Unicorns with One and Done Funding. So soon-ish, those of you that are software companies might be able to just raise one round and say, see you later, let's go. But most of you will need to raise multiple rounds. And the reason these outcomes are so important, they need to get the next stage of investors excited enough to invest at that point, right? So you raise a round of funding, you get time and resources, you accomplish things. Those outcomes need to be sufficient to get the next stage of investor excited, so excited that they will reward you with a double or triple of your valuation. Maybe sometimes it happens it's even higher than that. That's why the outcomes are so important. If you don't accomplish those outcomes, let's say you come close, if you're raising your institutional seed round, the next round of funding we might call a Series A. If the outcomes don't get the Series A investors excited, let's say you fall short, you're in what I call the fundraising chasm. I describe it in the book. I've got an article on it. You fall into the chasm. The Series A investors are like, kind of close, but not quite. You got to $70,000 in monthly recurring revenue. We kind of need to see $100,000. You have your marketplace running in Austin, Texas. We need to see you in 3 different geographic markets. Oh, crap. I wish I would have known that, because I would have raised more money at the seed round so that I could have accomplished those things to get you Series A investors excited. So when you fall into the chasm, it's very difficult. Your valuation is too high for the previous stage of investors, and you haven't gotten the next stage of investors excited, so you fall into the chasm, and it can be bad. I have an article about how to get out of the chasm, but you just don't want to be there. So since these outcomes are so amazingly important, why would we start with the money and work our way left to right? Don't work left to right, work the model backwards. Forget the amount of money for a minute. Forget that every other seed stage startup that you talk to that's raising their institutional seed round is raising $2 million. Delete that number from your spreadsheet. Just start with what do the next stage of investors need to see to get excited about leading that future round? How do you find that out? Not just reading articles, you go talk to them. If you're raising your institutional seed round, before you do that, you have to go talk to the Series A investors. Hey, Series A investor, I'm not ready for you, but you invest in the kind of stuff that I'm working on. So I want to tell you what we're working on. That seems kind of exciting to you. What would get you excited about investing in my company in the future? What would you consider ready for you? And then you close your mouth and you write down everything they say, and you compare that to the 5 or 8 or 12 times you talk to Series A investors. Now you know the outcomes you need. You can work your way backwards to what combination of time and resources am I going to need to accomplish those outcomes? That's now when you're in the spreadsheet. Oh, I need 5 more engineers, and I need a CNC machine, and I need to crank up my marketing spend. I need to get to 100,000 in MRR. And out of that is going to spit a number. It won't be a nice round number, so you'll probably nudge it up to buffer it because shit happens, and you might get punched in the face, and we don't want to tell an investor we're raising $1,865,000.86. So we round them to more round numbers. But do you see how I'm working the model backwards? This is so critically important. Because if you do this, I'll just start with your seed round. It starts from the very beginning, your pre-seed round even, when you're raising from angel investors. They want to know that you can get the seed stage VCs excited. So we raise money, we accomplish outcomes, and we use those outcomes to get a nice 2 to 3x step up in valuation so that we can go raise our Series A. Now we have new money in the bank, we have new time and resources, we can accomplish things, outcomes, that get the Series B investors excited. And this keeps playing out until you no longer need to raise money or no longer choose to want to raise money, right? There's no rule that says if you raise a seed round, you have to raise an A and a B and a C, D, E, F, and G. You stop this journey whenever you no longer need or want the money. But if there is going to be a next round, you better focus on the outcomes, okay? Is everybody clear on the concept? Sorry to beat a dead horse. You can tell this is really important to me. Just knowing this, you will speak the language, the vocabulary of investors, and you're already ahead of 96% of every founder that hasn't already been in this movie before. I'm serious. You will be speaking their language. So one thing that happens in the seed round, the nomenclature we use for these rounds of funding tends to change every couple or a few years. If you ask me, hey, Gordon, what is a typical set of outcomes a Series A investor would get excited for a software company? And how much do they typically raise and at what valuation? I need to say, what time frame are we talking about? Right now in 2025? Or 8 years ago? Or back in 2020, back in 2000 when I raised my first round of funding? You would hear dramatic differences. So we need to kind of adjust this nomenclature, but one thing is true, Series A has drifted further and further out into the life of the company, the maturity of the company, the milestones that are needed just the bar keeps moving. And so it's fairly rare that a startup would raise a seed round of funding, let's say kind of an early seed round, and gain enough funding to get all the way to the accomplishments of a Series A investor. It can happen. I'm just saying it's rare these days. So one way to figure out in those early days, maybe you're just thinking about a $500,000 angel round. Can you get to a Series A? Well, just go ahead and talk to some Series A investors, work your way back to the time and resources, and one thing you might find is, oh my God, I would need to raise like $3.8 million right now from angel investors when I don't even, I barely have a prototype product and no paying customers. Okay, that might bust you right there. You can't raise a $3.8 million round from angels because they write $25,000 checks, maybe 50. Just do the math how many angels you need. It's impossible, right? Or let's say you could. Somehow you have a magic touch and you could raise from 186 angels at 25 to 50K a piece. The valuation they will reward you with, you'll be giving up 95% ownership of the company. So you're either going to bust on the amount of money needed or the valuation is what likely happens. So this is just going to help you figure out, okay, I need 2 rounds of funding during what we might call the seed stage. I'm going to raise like an angel round, and I'm going to accomplish things that get the seed stage VCs excited, and then off of that, I'm going to get the Series A investors excited. So do you understand how I'm trying to use the same concept for another purpose? Is it going to take me 1 round or 2 to get to a Series A? Okay? Hopefully straightforward. I have a much longer version of this. I go into a lot more detail in articles that I've published and in the book, but that's the most important part of that concept. Any questions on that? Yes?
Yeah, do you find stories from founders that talk to either the angel or seed or Series A and the goalposts move? They say, oh, we need to see this, this, and this. You come back with this, and this. And they go, no, it's actually that, and that we wanted to see.
Good question. And I don't think I have the slide on that topic at the end. At the end, I have the most common issues that you're going to face and some hints and tips to address them. Just in case I don't have that slide, the answer is investors will drag you out as long as they possibly can until they're forced to write a check. Think about it. I meet with you, what you're working on is crazy exciting. I kind of want to give you my money right now, but if I'm one of your earliest investors in the round, why would I be one of the first 5 or 10 investors if I can kind of give you another homework assignment? Shit, my wife and I are going to be traveling international. We'll be back in about 2 weeks. Could we meet again then? Oh, okay, could I have you talk to my friend Nick over here? He's an expert in medical devices like what you're working on. I'm not an expert, so could you go meet with him? I'm doing whatever possible until you might come to me and go, hey, Gordon, like I told you, I was raising $1 million. I'm at $950,000. I got like $50,000 left. Do you want to get in or not? Oh, shit, I didn't know you were like that close. Yeah, here's my check. So just think about it from the investor's perspective. You get less risky the longer they can watch you progress. You might accomplish more milestones, which makes less risky. They can get to know you better. They can see if the round is coming together. To you, it might seem like they're moving the goalposts. Maybe that's possible. Maybe they're just stalling until they have to write a check. Okay? And I'm going to cover a lot of, well, not a lot, not as many as I have time for, but I will cover some other common issues. Thank you for the question. All right, in the back, and then we'll go here, and then I'll move to the next lecture. Yeah?
Yeah, is there kind of a rule of thumb template for percentages that are given away at seed, angel, and then obviously Series A? They're all very different stages.
Thank you.
And obviously retaining ownership throughout that process, so you're not a slave just to the investors
Yep.
in Series A.
Thank you. If you couldn't hear the question over here, how much ownership should you expect to give up with every real round of funding is the basic question. My general rule of thumb in these early-ish ranges, seed, Series A, pre-seed, seed, Series A, would be 20 to 30% is what you would give up. I realize you can just say 25% would be a midpoint. All that means is if you tell me 3 months from now that you raised your institutional seed round and we're only diluted 18%, I'll probably give you a little high five, like, hey, pretty cool. If you tell me that you were diluted 35%, I go, that probably hurt a little bit. Don't worry, maybe you'll make it up in the Series A. So my rule of thumb would be 20 to 30% for a pre-seed, seed, and Series A round. As you get to the B, C, and D, it tends to be less, maybe 15 to 20, okay? I'm on the board of directors for a crazy exciting startup. The last 2 rounds of funding, they diluted 10% or less. We all high-fived big time. Just a rule of thumb. Somebody over here? Yes, sir.
Is it ever too early to engage VCs? Like if you're really early on and like it comes off as wasting their time? Or
Yeah, thank you.
how do you balance that?
When is too early to engage a VC? My tendency is to almost say never too early, but you are right that about the waste of their time. I would say if your business plan, the ink is still wet, I mean, if you happen to know a VC or you're at a Capital Factory event and there is a VC, hell yeah, man. If you're at a networking event, there's one there, why not? But to go knock on their door or send them an email like, hey, I haven't even put my hands on the keyboard or soldering iron yet, but I'd love to meet with you, they're not going to meet with you, right? But it's not long after that. Like if you're working on something that is in their sweet spot, on their website it says, we invest in startups at this stage, in this industry, and these types of technologies, and you go, wow, check, that's me, check, that's me, check, that's me. They possibly and probably want to meet with you earlier than you think. You might not be able to get a general partner's attention if you're, let's say, pretty or way early, but you might be able to get the attention of a senior associate or a venture principal. These are their scouts. Their job is to know what all of you are working on so that the 3 of you that are working on something that's kind of within their thesis, they are supposed to be tracking you. They get yelled at if you go raise a round of funding and their venture fund didn't even get a chance to look at it. They get berated by the general partners. So your way to kind of let them know what you're working on early would be to find a senior associate or a principal. And at the right time, they will help you get some awareness with somebody that has a partner or general partner title. Does that help? Yeah. All right. I need to keep moving so that I don't keep you too late. And remember, I'm going to stay for a while. All right, so now you know the amount of money, you know when you should raise. Now we need to talk about in the seed stage that we're talking about when you're still pretty early, either no revenue or early revenue. I want to talk about the funding mechanisms that you might use, the vehicle, the key vehicles and the terms. Most investors, most venture investors, angel investors, VCs, they want to own some equity. They want their name to be on that ledger that we call the cap table, the capitalization table. They want to see their name, and in another column, they want to see a quantity of shares that they own, and then right next to that, they want to see a number with a percentage sign next to it, their ownership percentage, because they want to be able to multiply that ownership percentage times a really big number, and that's the return they get. So they want to own equity, but there's a lot of challenges when you're really early, you have no revenue or early revenue. It's really hard, like how do we set the valuation? There's no mathematical formulas for this, so we're kind of making it up. I have a whole article, a whole set of lectures and videos just on that. There's higher legal costs. When you sell equity, you have to go create the equity. You have to negotiate all the special terms of these preferred shareholder rights. And you're going to have to give up some things. When investors get preferred shares, they get special voting rights. They get special economic rights like pro rata rights and liquidation preferences. One of them that's the biggest investor is probably going to ask to sit on your board of directors. Maybe you don't want somebody telling you what to do in these crazy early days. And so these are some of the challenges of selling equity in the early days or the early days. And so there are instruments that we call convertible securities that we can use that are pretty flexible. They don't cost much money in legal costs. And the investors don't get equity right at the time they invest. They get their equity later. So you don't have them sitting on the board, you don't have them with special voting rights, you don't have all these other things that you have to give up. And the one I want to start with, the convertible security I want to start with, is called a convertible note. Okay, it used to be the only tool that we used. Then it was not the only one, but the most popular one, especially here in Texas. Now things are flipping over to a cousin of the convertible note called a SAFE, which I'm going to touch on very briefly. But let's start with a convertible note. It is debt. The word note means debt. You are in debt to these investors. But they don't want you to pay them back principal plus interest. Remember, venture investors are not excited about a 6% return with interest rate. They need a 10x or 20x or 30x return because of the high risk they're taking. They need a super high reward. So instead, this convertible note is intended to convert into equity in the future. It converts to equity in the future when you do raise an equity round of funding. When you get with a VC and they say, hey, no, we insist on having equity, you will negotiate all those other terms for what kind of rights they get, both economic and control rights. And at that moment, the previous investors that used a convertible note, they then convert into equity. And there's some formulas. I'm going to describe the formulas, but that's when those early investors get equity. And you'll probably use a convertible note or convertible security with your friends and family. So if your first round after bootstrapping is a small friends and family round with your cousin Sally and previous coworkers or whatever, they'll probably use a convertible security and they'll get equity later. Now, since they get equity later, and that future investor, I'm going to call them, it's your institutional seed round. It's a seed stage VC that you negotiate the equity round of funding. The seed stage VCs are going to negotiate the valuation with you. And let's say it's 10 million or something. Well, it wouldn't be fair that your Aunt Sally, who invested when you were crazy risky, it would not be fair if she converts into equity using the same $10 million valuation. Like, you were way riskier, right? So how do we accommodate that? Well, we accommodate it in a couple ways. One, Aunt Sally gets a discount. It's almost always a 20% discount. Like, I don't know the stats, but I'm going to say 98.5% of the time, the discount is 20%. We can argue whether that's fair or not. I don't think it's fair, depending on how long transpired, but still, that is what it is. So Aunt Sally doesn't get a $10 million valuation for her calculation of equity. We assume that the valuation is only $8 million for her. 10 million minus the 20% discount. So do you see, Aunt Sally's money on a dollar for dollar basis will get her a little more equity than the VCs. And that's very fair, isn't it? Because she invested when you were a lot riskier. I'm using Aunt Sally, just substitute angel investor, whatever. But what would happen if instead of 10 million, magic happens? Like, what you're working on, the world suddenly decides it's what everybody needs, you get into a hype cycle, and you raise that seed round of funding with VCs not at a $10 million valuation, but at a 20 or 30 or 50 million. Gosh, it wouldn't be fair that Aunt Sally and some early angels only get a 20% discount. Like, if it's 30 million, like, really? They're going to convert into equity at a $24 million valuation? Like, wow, that doesn't feel very good. because they invested when you were so risky that if you had forced yourself to agree on a valuation, it would be way, way, way lower. So there's a protection mechanism that we call a cap. It's a cap to the valuation. It's called the valuation cap. And it sets a high side limit that says, but it won't be higher than this. So now we have two economic advantages for the convertible note holders, a discount and a cap. They don't get both, they get one or the other, whichever is more favorable for them. And I'm going to show you how this works, okay? You with me conceptually before I give an explanation? Hopefully the explanation will make it crazy clear. So let's say that the next round of funding you're going to raise is a Series A, and that's the one that triggers the conversion. And what we have is a convertible note with a 20% discount and an $8 million valuation cap. So you see the line, the horizontal line of the cap? Now I'm going to show you three different scenarios for the Series A. And based on the Series A valuation, we're going to figure out what the valuation would be for the convertible note holders. In the first example, your Series A valuation is $7 million. It's below the cap. When we apply the 20% discount, the result would be $5.6 million. And in fact, $5.6 million would be the valuation that your Aunt Sally and early angel investors would convert to equity using. 5.6 for the convertible note holders, $7 million for the Series A investors. Simple, right? All I did was discount 20%. Let's push the Series A valuation above the cap, $9 million. But when we apply the discount, the result is 7.2. So in that case, 7.2 million is the valuation the convertible note holders would use to figure out how much equity they get. The next example, I'll need to nudge it a little bit higher. We'll nudge it to 12 million. If we apply the 20% discount, it would suggest a result of 9.6, but 9.6 million is above the cap. And so in this case, we reset to the cap of 8 million. In that third example, Aunt Sally and the angel investor did not get a 20% discount, did they? They ended up getting a 33% discount. So now we can just, like if the valuation had been 16 million, they would have gotten a 50% discount. If it's 24 million, they would have got a 67% discount. Do you see how it works? Yeah. So the main term that you will negotiate when you're using a convertible note is the valuation cap. We don't really need to negotiate the discount because it's always 20%, unless there's some reason you're in distress and you need to give a deeper discount. We're not really going to negotiate the interest rate that much unless you try and get away with 3% interest. They'll go, come on, give me a break. So, okay, the interest rate's going to be between 6 and 8%, so we don't really need to negotiate that very much. It's really the valuation cap is where you will spend your time negotiating. Okay? You with me on the basics for that? I have a whole article on this. You can search on convertible notes if you need to refresh your memory, etc. Okay, a very popular alternative to the convertible note is called the SAFE, a simple agreement for future equity. It came out 10 or 12 years ago. It is not debt like a convertible note, but in other ways, it operates very much like a convertible note. It has valuation caps and discounts. It converts into equity in the future when you raise a future round of funding. But since it's not debt, it doesn't have a maturity date. A note has to have a maturity date, and at the end of the maturity date, if it has not converted to equity, you have to go ask investors permission to extend the maturity date. Well, you probably don't like that. I do like that. Like if 3 years goes by and it reaches maturity and it hasn't converted, I kind of want to talk to the company and know, hey, what's going on here? You know, is everything okay? And, you know, I'll gladly extend the convertible notes maturity date as long as I have a valuation cap and I kind of understand what's going on. So in a way, I as an investor like convertible notes because they don't let you just run and hide and disappear. You don't like it for the opposite reason, right? Okay, so these are the two key differences. You will find that these convertible securities are used in the early rounds of funding and smaller rounds of funding. So friends and family rounds, angel rounds, small seed rounds of, let's say, $1 million or less would be very popular to use these. you can use them even higher. I mean, you'll see some things where we've seen startups raise 10 and 20 million dollars using a safe. So it can happen for certain reasons, but the sweet spot would be those stages. And then once you get to the 2.5, 3 million and larger, and certainly when you get to Series A, B, C, D, E, F, and G, yeah, those are equity rounds of funding. Does that help? You understand the concepts of these instruments? If you have never used one before, you're going to want to educate yourself a lot more. Talk to your attorney. Don't just download a template and stick it in front of a bunch of investors and have them sign it, because you might royally screw up your Series A, okay? There are a couple little things in there that you need to make sure it's compatible with what you're trying to accomplish. Please don't download a convertible note or safe template and just stick it in front of a bunch of investors. Even if you don't change a single word, the hour or two that you spend with an attorney to make sure you understand what it is, to document the appropriate approvals to even raise the round of funding. You might think as a C Corp you can just kind of fill out this template, stick it in front of a bunch of investors, life is good, woohoo, we have $500,000, and then you go raise your round from a VC, and they say, hey, can you show me the board minutes or the unanimous written consent in which you authorize that round of funding and you authorize those terms? And you go, what board meeting minutes or unanimous what consent did you say? You're in big trouble, big trouble. So even if you don't change a single word, if the only thing your attorney does is make sure it's compatible with your bylaws and the laws of being a C corporation, they just saved your ass big time. I'm saying this because there are a million templates out there that are one button click away from a download and shove in front of an investor. Me as an investor, believe me, I've been punched in the face a couple times because of this, and before I sign it, I'm going to ask you that question. I'm just trying to protect you. Your Aunt Sally does not know to ask that question, and some angel investors might just assume that you're working with an attorney. Okay. Everybody all right for me to move to the next session? Yes, ma'am.
So I believe Y Combinator was the one that introduced safes quite some time back, but given the difficult fundraising environment in the past couple of years, I'd expect that convertible notes are more in favor, more investor friendly compared to safes. So what's been your actual experience there?
That's a very that's such a great question. I want you to have an autographed copy of my book. Thank you. That's a good question. Yeah, I like that a lot. The safe is very popular. I would say in Texas, 80% safes, Nick? 70, 80%, or something. Lots, at least, right? I'm sorry. Thank you for holding me accountable. Because of economic difficulties or difficult fundraising environments, when that happens, do investors kind of like switch back over to a convertible note instead of the safe, is kind of the implication of the question. Not as much as you might think, okay? I'll say that there is either a willingness or a non-willingness on investors' parts to use the safe, and probably once they're okay using the safe, I don't know that just because of an economic condition they would switch over to the convertible note. Like, here's what we like about convertible notes. It is debt. So if I invest with a convertible note, I hold debt with you, vice versa. You hold debt with me. It means if things don't work out so well and you have to sell the company in distress or you have to close it down and there's some amount of money in the bank or there's some piece of equipment that you could sell, guess who gets paid back first? Me. Before you go pay any of the equity holders, debt comes first. I like that. The other thing I like is if it crashes and burns, it's very clear. The IRS rules are very clear how I write that investment off. It's non-business bad debt. Easy. Boom. Done. The safe, it's a little bit, even today, we've had this damn safe for so long. You go read the articles on how to write off for taxes when a safe investment goes bad. You'll just still see debates. So I guess, yes, there might be a little propensity to switch over in more difficult fundraising times. I think instead what will happen is an investor willing to invest on a safe is still willing to invest on a safe. They'll just beat the crap out of you on the valuation cap, and they might insist on a 25% discount instead of a 20. It's possible they'll write a little side letter over on the side that says something, you know, you have to come ask my permission anytime you want to spend more than $50,000, or I think they would protect themselves in different ways. It's a very good question. All right, back here, and then we'll move to the next lecture.
Yeah, so the cap is the main thing you're negotiating, right? So I guess what do you look for to justify a cap? From a founder perspective, like what would be a strategy to say, no, it should be 12 versus 8?
Yeah, thank you. The question has to do with if the cap is the most negotiated term, which it is, how do you negotiate that? It's a very deep topic. I'm going to give you one or two basics, but before I do, I wrote an article titled Negotiating Valuation with Investors. And it doesn't just apply to these instruments, it's really negotiating valuation with investors for any round of funding. But in that, I describe there's kind of like this 6-step process that they kind of go through. With convertible securities, one or two of those can kind of get eliminated. Investors don't think exactly the same as VCs. So on my Shockwave Innovations website, that's where all my articles are for those of you that weren't here yesterday, shockwaveinnovations.com. Just do a search for the word valuation, you'll see that article. In the early stages, even through a Series A, we're not doing mathematical calculations. Please, those of you that have an MBA or you have a finance degree or you work in investment banking, do not open up your discounted cash flow spreadsheet and plug in numbers for your future projected cash flows. It's a waste of time. You're just going to discredit yourself, with me. So don't do that. Instead, what we tend to do is the first starting point is comparables. You tell me some things about your startup, the size of your market, where you are in terms of traction, some things about your team and how badass they are or aren't. And as you're revealing these things through your pitch deck, my investor brain is a pattern matching brain. I don't like this about myself, actually. But as an investor, when I'm wearing that hat, I am a pattern matcher, and I can't turn it off. You're revealing your business plan, and as you do, my brain goes doot, 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 and then you tell me something else, and it goes doot, 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 doot. And I just keep narrowing it down to, and what I'm trying to do is identify other startups like yours that successfully raised a round of funding, that we decided to invest in, that whatever. And like yours means similar market size, similar type of technology or product, similar team, similar traction. I won't find a perfect match, but this is kind of becomes my starting point. And so what happens, like each time I kind of do this, a number just pops into my head, and it's like 8 million, and then you tell me more, and the number either goes up or goes down because I get more excited or I get less excited. And this is honestly the starting point. My article goes into the 3 or 4 other things then that follow that. And if you understand that, you will be inside the investor's brain and you'll be able to get ahead of it, including return on their investment. Venture investors need to see their way to a 10x return or greater. Some funds will be 20, some are 30. Once you know that, and the formula is pretty simple. I give you the secret formula, and you don't even need to know calculus to do it. It's very basic algebra, and in my article, I give you the formula, the way the investors are going to think about what needs to happen to get a 10 or 15x return on this investment. You run the calculation ahead of time, so you already are inside their brain. There's a lot more to it than that, but I hope those 2 things were kind of helpful. All right, I promised to tick through some of the most common issues and then some hints and tips to get around it. The first one is this dilemma of running the company versus fundraising. In the early days, it's you and a dog, or you and a co-founder and 2 part-timers and a dog, okay? You don't have like this staff of 5 vice presidents and 18 directors, and so that you, the fundraising founder, which is usually the CEO, can just like check out for 3 to 6 months and go fundraise. So it's unfair and it's excruciatingly painful, but it's true. In these early days, you're already wearing a bunch of hats and you need to put the fundraising hat on. And when the fundraising hat goes on, almost all of the other hats need to come off. Because dialing in your fundraising at 20% or 30% or even 50% of your time is going to be excruciatingly punishing. Why? It already takes longer than you think to raise a round of funding. While you're raising the round of funding, you can't focus on the business. So the results that were going like that all of a sudden start to get wobbly or start to level off. Maybe they go like that. Then you don't look so exciting, and the investors are using that against you. And you're going to say, but it's unfair. I've been fundraising for the last 6 months. I haven't been able to go close all the deals. And they go, I'm just looking at a graph, man. So you don't get forgiveness. So you don't want your funding round that could finish in 4 months to take 9 months. And if you try to dial it in at 40 or 50%, unless you're the hottest of hot startup, unless you are a serial entrepreneur that's done this before and returned millions and millions of returns to your investors, there are situations. If that's not you, unfortunately, you got to crank it up to like 80%. And there's also this momentum effect. You got to create this crescendo in this momentum and then capture on it. When you dial in at 40%, it's just kind of like there's a drib and a drab and then a drib and a drab, and you're not able to kind of create this momentum. So I actually, in my book, break the fundraising cycle into 3 phases. Many founders will just you'll go out of this room, and if you sneak out right now and you don't hear the next thing I'm going to say, you might make the mistake of just kind of drifting out there and hey, I'm just going to go start raising a round of funding. And if you haven't done the strategy and planning part first, then you will be adjusting and adapting in real time, having already had some investor meetings. You can't go back to an investor a month or 2 later and say, I know when I met you back then, this is what I told you. Actually, I realize the amount of money I'm raising is totally wrong, and the valuation and other terms, but I have a new answer now. Can we meet again? It just doesn't go well. So the 3 phases, one of them actually is a phase where you're not even raising money, and it's not in the immediate or near future. This networking and relationship building, let's call it investor discovery. One of the reasons why Nick might tell you that founders are always fundraising, what he really means is you're not always asking for checks. You're always doing something that relates to your fundraising strategy. Even if you're building relationships and continuing momentum and keeping certain interested investors updated, it might take 10% of your time. That's all, but it's related to fundraising. Then as you get closer to a round of funding and you go through the money equals time and resources equals outcomes, and you're working this and you have a theory for how much you should raise and why, you take it out for this test drive. You go to the investors that you've been maintaining a relationship with and maybe a handful of others, and hey, we're not raising right now, but I'm probably going to kick it off here in the near future. Would love to tell you where we are, love to tell you what we're thinking, and I'd love your feedback. And in that test drive, you can use ranges. You won't be totally discredited if you say, we're going to raise between 2 and 3 million for our seed round of funding. Hey, if it's 2 million, we can accomplish this. If it's 3 million, we can accomplish this. And you'll have this dialogue, and hopefully you'll get some feedback that once you've done that, then you can run the campaign. You've got increased confidence, not a guarantee that it's going to work, but less risk of whipsawing yourself on a bunch of things. And that's the moment where you put on that fundraising hat big time, and you crank it to 80%, and you run like hell. And hope to get it done in 3 or 4 or 6 months, not a year or longer. Okay? Yeah.
When you say finalized terms, I kind of know what I want, but often you speak to different people, they don't want what you want.
That's right.
But you want them as an investor.
Mm-hmm.
So how do you manage that situation?
So the question relates to, this founder kind of knows what she wants in terms of terms. Maybe the investors don't agree with that. I'm hoping that you can, let's say, mostly reconcile that in the second phase of the test drive.
But what about if it's like you want to do a say and they want to do a price?
So now let's say that this I'll in my answer I'll try and include the question. You've gone through the test drive. You have you have something you think will work, but you get out there and you're running the campaign and you're using SAFE. And an investor says, not going to do that. It needs to be a convertible note. Do you short circuit? Some of those issues can be addressed. It is possible that in the same round of funding you could mix convertible notes and safes. Talk to your attorney before you do that. The valuation cap and the way it's treated might be incompatible, but there is a way to have some safes run alongside convertible notes. So that's an example. A different short circuit that's probably not going to work is you got a bunch of investors agreeing to a $10 million valuation, and this one says, no way, 7 is the maximum. If you agree to 7, you got to go back to all these others and go, hey, guess what? I'm going to give you a birthday present. And you might choose to do that. So yes, this definitely happens. And you accommodate along the way. You'll have to say no to some. You will end up saying, like, I'm sorry, and just telling them no, and then guess what? You get close to finishing the whole round, they might just drop back in. It can happen. Okay? I want to talk about the pre-seed round, because pre-seed round often are described as, or go along with, funding rounds before you have a working product, a shipping product, before you have customers. It means different things for a medical device company and an advanced robotics company versus software company, but let's just say the crazy early days before you have traction and exciting things. During that round, and especially if it's from angel investors, you need what I call a hyper-intersected angel. Not just some woman that's rich, not good enough. She needs to be intersected with your business plan in one or more ways. More is better than one. What does intersected mean? It means she's a badass ninja in your industry, your type of product, your business model, your technology, some chapter of your business plan, hopefully multiple. She's a badass ninja, okay? This is really important because I know this from experience. My entire career before starting Capital Factory was in enterprise hardware and software. I knew how to build and sell products, software and hardware, to the Fortune 500 and the Global 2000. I never built a consumer product, never built a mobile app, never sold to a consumer. But when I started doing angel investments, I kind of fell in love with some mobile apps for consumers. I wrote some checks that very quickly crashed and burned. And I stood back and I was like, what is the difference between these? And it was just amazingly obvious and an embarrassing moment for me. With the mobile app for consumers, after about 10 questions, I ran out of questions to ask because I didn't know where to dig deeper. And it just sounded really exciting, and I wrote a check. With the enterprise software and hardware investments I looked at, I never ran out of questions. Like, I could have locked those founders in a room for 3 days and never run out of questions, and I'm kind of not exaggerating. You understand the difference? Think about the risk I was taking when I'm investing where I was not a ninja. You got to go find the intersected ones. Angels don't have websites, so how do you find them? That's a whole nother discussion, but don't waste your time on a random high net worth individual just because you heard they're an angel investor. The first part of your dialogue with them at a networking event or a angel network group or whatever, you're seeing if they kind of know what you're working on. There's one exception here. I might invest in a mobile app for consumers if Nick invests in it and he's a badass ninja at that, and I've invested alongside him, and we've made some money because he did all the hard work. You got to go get those first, and if you can get some of those, then you might get with a high net worth individual, and I say, I don't know anything about medical devices. Hey, no problem. I've already got 5 angels. They're doctors, they're product managers that have launched 18 FDA certified medical devices. I'd be happy to put you in touch with a couple of them. Oh, really? You see the dramatic difference there? All right. Next, we only got about 6 minutes. I want you to understand that these convertible securities allow for an attribute called a rolling close. There's no single deadline that everybody writes their check. You get an investor excited, they sign the documents, boop, they write you the check. This is amazing, right? You're raising $500,000. Each time there's a 25 or 50K commitment, you get to take the money, put it in the bank, and maybe start to use it, right? Part of the downside is if it comes in slowly, you can't really shift the gear because you don't know, am I going to get to? So if it stretches out, this can be a problem. There's another problem. The investor that is the sucker to write the first check is taking the riskiest investment. The investor that finishes you from $475,000 to your $500,000 target is making the least risky investment. I like least risky versus most risky. So when we meet, I'm crazy excited about you, but to this gentleman's question, I'm going to give you some more homework assignments. I'm going to have you go meet with Nick so he can poke and prod on you. I'm going to go on vacation for a couple of weeks, whether I really am or not. I'm going to tell you that I'm a little short on cash right now, but I have an exit that's maybe coming, and if that if I get that exit, then I'll have some flush with cash to invest. Why that might be happening? Because I'm not going to be the sucker to write one of your first checks. I want to kind of wait. But if I tell you, love what you're working on, come back to me when you're at 475 so I can top you off with the last 25,000. If everybody does that, how do you get to 500,000? I just want you to understand that experienced investors know this risk. So you might need to give the first investors in your round some favorable terms. They're taking a riskier investment, so it does happen from time to time. I wouldn't necessarily start with this, but if you get out there and your investment opportunity is not as hot as you would like, and they're not just throwing money at you, you might need to say, we're raising $500,000 at these terms, but for our first $100,000 of investor, we're offering a slightly lower valuation cap or a little bit higher discount. And you're acknowledging that they're taking a bigger risk. The other thing that you might do is ask them to be verbally committed. Look, I get it, you still don't want to write your check. Can I consider you verbally committed until I get a few others, and then we can have a check writing party? So there's no first investor. There's 3 or 4 or 5 of them that write their check at the first together. So you might use these tools to get your first investors on the dance floor. Then you go into the grind, trying to get yourself to 60, 70%, and now you're on the downhill slope, right? You've only got 30% left, and your messaging might change. Hey, we're raising $500,000. We've only got $75,000 left. Can I save a slot for you? Whoa, save a slot? Like it might go away? So that's the dance of the rolling close. If you get an investor that just drags you on and drags you on and drags you on, you might need to ask this question. And this is the way I like to ask it. Hey, Gordon, we've met a few times now. You've gotten a lot of information. What do you need to see for this to be an exciting investment for you? What is it you need to see? What do you need to see? Now, if I have a concern, I'm going to tell you the concern, right? And maybe you can address it, maybe not. Remember, if you're dealing with an investor and they're not investing, it doesn't mean you're not an exciting investment. It's a competitive marketplace. We have look right here. There's 40 or 80 investment opportunities right here. So yours is an amazing opportunity, but hers is better. Like, yeah, yours is very fair. Here. So it's a competitive marketplace. And since they have alternatives, if you're finding that 80% of your investment interactions, you're arguing and debating and defending your valuation, one thing I can tell you is you're not worth as much as you think you are. It's just like if they're not writing the checks, and you don't want a large majority of your fundraising interactions to end up in long debates. I'm not saying they won't ask it and like, well, how do you justify that? That's just natural. I'm saying the main thing is that preventing you from moving on is valuation. If that's happening a majority of the time, you're just going to keep beating your head against the wall, okay? All right, I touched on the most important things. We only got 2 minutes. I apologize. Question here. Might only get 1 or 2, and then you'll be next, and then we'll break. Yes?
I would love to hear your wisdom on hardware versus software funding and the hybrid, which is IoT.
Mm-hmm.
Do's and don'ts.
So the question is hardware versus software funding, including IoT. There's all different categories of hardware. The fundamentals are the same. One thing that would be different is hardware companies typically need to raise more money and earlier than software startups. Hardware startups typically have a longer journey until they have a working product that they can, prototype or demonstrate or launch into the market. Software startups, man, especially with vibe coding and shit now, like, oh my God, like you guys can whip out a quick demo that it's just vibe coded and doesn't really work on the back end, but gives you something like it's going to be amazing right now. Now, every hardware startup is also a software startup, so they might be able to use some amazing, AI code generation for their hardware product. There are fewer investors that understand hardware, therefore fewer that will invest in hardware. This trend is kind of shifting, and if you read my article titled Building Unicorns with One and Done Funding, one of the trends I talk about is once you software startups don't need near as much funding or near as many rounds, what are the VCs going to do? I think there's going to be a dramatic impact to the VC industry, and many of them that were only investing in software are going to have to shift over where startups do need money. They raise money, they need startups to need money so they can put it to work. So more is going to shift to hardware, more is going to shift into deep tech. This is going to take a little while, but those would be just some of the attributes. All right, I exhausted the time. I apologize. I know I said I was going to take your question. I'm going to be around right outside. Hope that this was enjoyable, and I hope all of you have an amazing journey on your way to success. Thank you.
Thank you, Gordon. I heard the alarm. That must be the go see my grandbaby alarm. Congratulations. All right, we're going to do a rolling close on this session and move right into the next session. One quick thing, I get to interview a ton of people at Capital Factory. Always ask people, what's the difference between a safe, a convertible note, and a priced round? And I'm actually pretty surprised at how many people come into the interview and are saying, I go to Tech Week, I'm in the startup community, I listen to All In podcasts, but they can't answer that question. So everyone that just listened through that, you should be able to answer that question. I encourage you to talk about that and yeah, debrief, get comfortable with the mechanics. We're gonna go from a fundraising mechanics, brass tacks talk from Gordon into a more storytelling, communication-focused session. We're gonna talk about telling stories beyond the numbers and really capturing investors, building investor confidence. We're joined by Tyselli Williams. She's the CEO of the Liberty Fellowship. She's raised over $600 million in her career. That's a nice chunk of change, also gobs of cash. And she'll share her proven framework for building investor confidence, storytelling that sells, and relationships that last well beyond the deal. So without further ado, please join me in welcoming Tyselli Williams to the stage. Welcome, Tyselli.
All right, I love the energy in the room. Hey, y'all, hey. I am learning how to pronounce howdy. Josh is going to be very proud because I am going to get there. So I'm going to share a little bit about who I am. I'm going to share a little bit about how we're going to spend our time together. And then we are going to serve up an actionable plan for all of us to push forward success around relationship building. So how many of you were in Gordon's session? Who was just here? All right, that's going to be helpful. So I, too, like Gordon, I identify as a problem solver, a relationship builder, and a lifelong learner. Any problem solvers in the room? A few? Okay. Any relationship builders in the room? All right. Where are the lifelong learners? Okay. That's what's up. Now, because we are here to differentiate ourselves, right? We're going to start in real time connecting and building relationships. If you're like, wait a minute, this feels soft, you definitely need to stay. If you're like, wait a minute, this feels weird, this definitely is for you. If you're like, hold up, I think I'm in the wrong session, guess what, friends? You're exactly where you need to be. So here's how we're going to roll today. I'm going to tell you a little bit about me beyond the self-identification. And I want to invite you to begin thinking about who you are beyond an entrepreneurial startup, beyond a founder, beyond a tech exec. Gordon rolled in and centered an identity that mattered deeply to him. What was it? Grandfather. If you're getting to know Gordon and you do not know that he is a proud grandfather, what does that say about you and the strategy that's undergirding the pitch you're making? You're not prepared. You don't get what matters more than money. And guess what, friends? There's a lot that matters more than money. We are here to talk through how do you take an ROI and begin with the measure of success of increasing cash. That's kind of like a no shit Sherlock kind of moment. We are here to talk through exponential growth that not only yields an increase in cash, but it also grants instilled compassion, not in what you're selling, but how you're selling it, and the culture that you're creating within the businesses that you're launching. So are we ready to figure out what matters more than money to the person you're sitting next to? All right, friends, this is how this is going to work. We're going to get real comfortable. You're going to introduce yourself, and you're going to get a second time to introduce yourself because we've got 3 shots of matcha coming your way. Now, no instructions. Step into your authentic self. Meet your neighbor. All right. All right, so lots of neighborly conversations. All right. The neighbors are off and running. It seems like you like your neighbor. Yeah? Yes. All right, here we go. You like your neighbor? Yeah? All right, guess what? We're going to spend a little bit more time engaging with your neighbor. But here's the promise I'm going to make. I'm going to give you more time to engage with your neighbor because there were happy sounds, smiles, excitement. And when it's time to stop talking to your neighbor, we'll have to pause and settle back into community. Is that a deal? All right, here we go. So, who's in the room? Not you. Who'd you meet? Who's in here? A lawyer. Who else did you meet? A hunter, a mother. Someone saving animals. All right, that's cool. All right, who did you meet? A new Austin resident. All right, lots of identities. So here we go. A little bit about me that you cannot see and that my bio is not likely to disclose is that as a lifelong learner, I spent time in college learning from a woman by the name of Dr. Maya Angelou. Does anybody know that name? Sure, yes. Dr. Angelou would often say that she has learned that people will forget what you said. I mean, wait a minute. You spent all of this time with the pitch, with the responses, and you're telling me I'm going to walk out of the door and people are going to forget what I said? That's exactly it. People are going to forget what you said. People are going to forget what you did. You mean the deck that I sent, the recap, the performa, all that's unfolding with the growth, you don't even remember what I said, what I did, what I showed you. But people will never forget how you made them feel, right? Feelings matter more than the actions behind what you say and what you do. We're going to spend a little bit of time today thinking through how do you make people feel ways that are positive so that when someone sees you coming, they are running towards you and not away from you. Whether you're starting with your friends and family and you're knocking on the door of Aunt Sally, or whether you're preparing for Series A, what matters is that you are connecting and engaging with a living, breathing human being. We're all clear on that, right? So I'm going to introduce you to our first dose of matcha. This is going to influence your thinking so that your take 2 of the introduction now has an amped up empathy angle. This is a wonky social science configuration that I hope will influence the way that you're thinking as founders who need resources. You'll see here that there are 4 quadrants: says, thinks, does, feels. We're honing in on feelings. How many people have ever been to my friend Josh's Capital Factory? Is that all of us? Have we reached 100% of we can self-identify as people who have visited the Capital Factory? Who's a first-timer? Anybody like me? I'm a first-timer. So I love Josh, but I was a little unclear about what I was walking into. And so I turned to do what most people do when there's curiosity and uncertainty. I went to Google and I said, tell me more about the Capital Factory. And look at what came up. I don't know Pat W., but Pat says, this place is impressive. It's clean, modern. The staff was friendly. It's great for hosting large events and conducting conferences. Would love to come again. That is the feeling we want everybody who speaks to and with us to walk away with. I would love to talk to her again. He was so interesting, I would love to have an opportunity to sit once again and engage. So the first thing that I want you to think about in this marvelous mind of yours, what are you doing? What are you saying that is going to lead people to feel like, I can't wait to talk to them again? That's a real homework assignment, right? I mean, we are real people. I'm going to follow up. We're going to connect. Some of us are going to become friends. And I'm going to ask you, what are you doing to create this feeling? Okay? First shot of matcha. Second shot of matcha is going to come shortly after I introduce some social science. So the way in which I've attempted to structure our time together is I'm going to introduce some inspiration through the wisdom of Dr. Maya Angelou. I'm going to also interject some information, quantitative and qualitative. And because I wasn't sure if my voice was going to hold up, I have pinned more words on the slides than I normally would so that you can come back and revisit this. And then the third thing is imagination. This inspiration, this information is in service to your imagination. You are not just the founder of a product or a service. You are the chief evangelist. You are the one talking about it, doing things, and it is your responsibility to also make people feel a certain way. I want you to get some insight into Brett. So Brett is a co-founder of Patch. It was rebranded as Anagram in March of 2020, and he raised over $9.1 million of Series A funding at the time. And here's what Brett said. I wish I had given more credit in the early days to VCs for being smart and rational people who had more empathy than I thought for the plight of a startup. I think it's important to put yourself in a VC's shoes, not just the firm, but the partner, and understand how a decision gets made, the risk the VC can take and cannot take, and what they need and how firm dynamics work. So all that Gordon talked to us about from a tactical sense is wrapped in relational understanding. Everybody's making a decision. Not just the partner, not just the VC, but you are the first decision maker, beginning with the journey that you're taking them on. So, we're talking about feelings, and we're now going to go to the second shot of matcha. Are we ready? The second thing is tied and connected to Dr. Angelou saying, if you're always trying to be normal, you will never know how amazing you can be. I have a niece, which means I'm an auntie, and we went to McDonald's. Don't tell my sister. And I said to Lila, what type of sauce would you like with your chicken nuggets? And I was expecting honey mustard, barbecue, sweet and sour, and my precious 8-year-old niece said, Auntie, I just want the normal sauce. What is normal sauce? And there within, we stepped into a place and space of giving her permission to not want to be normal. You never want what's normal and average and conventional and mundane, and nobody wants to talk to someone who identifies in a normal way. Why is Austin weird and wants to stay weird? Who's from Austin? Okay, some folks are from Austin. Help us. Can you help us to understand why do we want to stay weird? All right, to be our authentic self. What does that mean? I have a sticker that says that, and what does that mean? I know Brene Brown is all about Texas and being authentic. What does that mean, y'all? Break it down for me. To think outside of the box, not pretending. There is nothing more unsettling than having a conversation when you're trying to be something you're not. And if you're trying to engage in a conversation about the investment of resources and you think, oh, I've got to step forward and look like the tech guy. I've got to put on my black t-shirt and put on my jeans. Well, if you don't wear jeans and a black t-shirt, guess what you're gonna feel like when you're talking to them? Inauthentic. Set yourself up for success, feeling as comfortable as you feel, right? I wear dresses. When I went to business school at Georgetown, I had a wonderful member of my class. There were 34 of us. He's like, Tysley, you're so smart. I mean, if you would just dial down the ruffles. Dial down the ruffles? I am the ruffle. Right? So, we are going to give ourselves permission in the framework to talk through the wonkiness of a social identity wheel. Everybody has a fingertip. I'm gonna probably sound like your mother for the next 2 minutes, or your Grammy, or your dad, to talk about how unique and special you are, because guess what, friend? You are. But the other thing that is really, really important about a social identity wheel is that you're talking to other people who are unique and different, and some things are visible and some things are invisible. Nomenclature is something that Gordon talked about. Nomenclature and words is the process by which we create shared understanding. So before you start pitching, if somebody doesn't even know the problem you're solving, to even understand the need in the marketplace, they don't even get the value, right? So you've got to be able to make things relatable for the person you're talking to, not you. So here's this deal about a social identity wheel. There's an internal cog, which is the individual. There's a primary wheel and a secondary wheel. Y'all are gonna break this down. We're not gonna get into this today. This is your homework because you're lifelong learners and you're super smart. But what are some of the things that you see in the core internal dimensions? What are some of the things that you see? Age, race, gender, emotional, romantic, sexual orientation, language, faith. So y'all, these are some things when you walk into a room, you just don't know who and what you're dealing with unless you what? Ask, engage, tell me more. I'm really curious about. How do you identify? Right? Create a culture and a norm where you are not looking like the village idiot. Because people are investing in the fact that you're a good decision maker. And good decisions transform beyond a spreadsheet and beyond your MVP specs. Good decisions begin with the ability to influence a marketing team that's going to market your product, that's going to be sold to people who don't look and think like you. How are you setting that up for success? With cultural competency and awareness. So we're going to talk a little bit more about social identities. But here within Friends is what I think the most differentiating element of what it is that you need to integrate into your thinking. I think this is a no-brainer as far as it pertains to the communities and societies and the marketplace. You know, it's like we use these technical words, the market. Well, what is the market? Who wants to tell me, what's the market? The people. Customers. So we're not just using the word the market because that makes it feel like it's something artificial and something other than like human-centered. The market is like peoples who wear ruffles, right? The consumer landscape in the US is changing drastically. The startup exec that I referenced earlier, the Latinos have become more prominent part of the consumer market, and you've got Forbes here giving us some insight into the fact that there are over 131 million multicultural Americans, actually making up pretty close to 40% of our population. So there are no more singular boxes, right? Things are blended. People take a lot of pride in their heritage, in their identity. And what we also know is that our Hispanics are accounting for the largest portion, which is really around 64 million people, just over 19%, with a projected $3.4 trillion in purchasing power. What I love about FinHabits, which is who we heard from earlier, is that the founder, Carlin, said it doesn't require being Latino to cater to the Latino market. But it does require knowledge of the nuances of the Latino culture. What does that mean? Understanding. I grew up in 1975, I entered the world. I've loved Barbie and Mattel from the moment I could dream. but there were not Barbie dolls who looked like me. And all of the black families in Birmingham, Alabama, supported a woman who would make dolls from pantyhose stockings. Because pantyhose stockings had variations of color. And she would make these little dolls with hand, and she'd stuff them with cotton, and she'd form them, and she'd get yarn that had hair that looked like mine, and she sold these dolls for 10 times what a Barbie doll cost. And we all bought them, and we all had them. And what does that say about Mattel? They missed the market. They didn't know who and what was in the market. They didn't know what people desired, what people wanted to buy, right? Dr. Angelou, and this is our last bit of matcha, and you're gonna get to do your intro all over again. If you don't know what you're here to do, then just do some good. I mean, if you're still trying to figure it out, if everything else is failing, but you've got a plan to be good to yourself, to be good to your friends and family who are investing in your dreams, to be good to your co-founder, to be good to your fractional workers, to be good to your consumers, that is winning. Two other little pieces that I'm going to introduce before I turn it back to y'all to talk to your neighbors. This is a wonky framework. It's the dominant approaches of entrepreneurial pitching. So when you get the slide deck, I want you to look at A. This is from the entrepreneur's vantage point. B is from the investor's vantage point. And y'all, what is in between the vantage point? The investment decision. That is the bridge you are forming with an innate understanding of what matters more than money to Gordon, the fact that he's a grandfather, right? So as you're coming up with your pitch, proposing your invitation, you've got to think through, how am I crafting this investment decision? Are y'all ready? This is a no-brainer. Everything begins with an introduction, right? You step forward into meeting a living, breathing person, and you introduce yourself. And what I want you to leave here with is an introduction that is centered into one of three options. I'm going to tell you a little bit about this Benevity Impact Survey. They surveyed 50 global corporate impact leaders, and here's what they found, right? 92% of the leaders are investing in social impact programs because it's good for business. What does that mean? They want money, and people are going to have brand loyalty and keep buying that product because they view that product as doing something good. Put on your consumer hat for a minute. Who buys in a loyal way from a brand because you know they're doing something good? Okay, is it Jessica? Jessica, who are you buying? What are they doing in the world that's good? Patagonia. Oh, any other Patagonia? Yeah, I gotta self-identify as a consumer as well. Lasts forever, and why Patagonia? They recycle back, they want their products to be built for the long haul. That matters to this consumer and likely many other investors. Who else has loyalty with the brand? And tell me your name. Christine.
There's a company in San Antonio called Fiesta.
Fiesta Feet.
And it's a
Woman-owned business, giving back to their community, some loyalty there with shared affinity and identities. We also learned through this study that 88% believe that their impact strategy is future-proofing business when it comes to talent acquisition, retention, customers, and regulatory requirements. So y'all, if you're waiting on the government to tell you to do and be good, guess what? You're missing it. Forget about it. 91% say they are making sure their programs support corporate strategy and values. So similar to the earlier quote, you're showing up to talk to the VCs. Each decision maker within the VC ecosystem has priorities, has values. They also have a corporate and a collective set of values. So I want to make sure that as you're thinking through your introduction, you're giving thought to that. So let me give you the instructions, because there's so much energy and excitement. Either y'all are excited about what's to come, or the matcha upstairs, Ryan, I think is really doing its job. So I want you to pick one of these. You're going to reintroduce yourself. I'm going to give you a minute, a literal minute. You all are type A drivers. You don't like stuff just coming up. You want to be prepared. You want to rehearse. Sorry. I want you to either introduce yourself as, hi, I'm Tysley. I make people feel. This is provocative and curious, by the way. You step in with this type of introduction, like, whoa, what do you do for a living? Right? I'm Tysley. I'm unique because. I'm Jessica. I do good by. Right? So you get to choose one of the 3 shots of matcha that we just introduced you to. And I want you to start practicing right here, right now, on how you differentiate yourself with normal introductions. You're not going to be like my 8-year-old niece who says, Auntie, I want the normal sauce. You're going to be wildly successful, like those who called Austin home, who differentiate themselves from people who aren't as cool as the people here in Austin. We're going to be unique. So I want you to think through how you're going to introduce yourself. Through feeling, through uniqueness, through nobility. Take 20 seconds and then reintroduce yourself to your neighbor. I know. All right, all right, all right. Good stuff, good stuff, good stuff. Are we ready? All right, so in the spirit of being equitable, there are 4 sections of this room. We're going to get volunteers from here, 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 and here. And here's how it works. Someone's gonna stand up and be a leader, and your neighbor is gonna be a faithful follower and say, I guess we're up. All right, so who's leading from the front? Come on up, come on up. All right, are y'all ready for this? All right, come on up.
No, and I'm the very first.
You are
oh,
the very
no.
first, which makes you so special.
Okay, hi. What am I doing? I'm sorry.
You're introducing
Introducing.
yourself.
Okay,
Yes.
perfect. Hi, my name is Ellen Pino. I am from Louisiana, and I make other women feel seen.
Are we curious about how Ellen makes other women feel seen? All right, Ellen, tell us more about what you're doing, girl.
When women come into my facility, they're coming to me typically in a vulnerable state. They feel uncomfortable about something in their skin. They're nervous about something. They don't see themselves like they used to see themselves in the mirror 5, 10, 15 years ago. And they open themselves up with a lot of vulnerability and trust me and my company to change that.
Good work. What's the name of your company?
I have some medical clinics back home called Avant 2. That's not what we're launching here, but it's the vehicle in which we found why we're launching what we're launching. And so, yeah, we service 30,000 women in South Louisiana and just help them become their authentic self and feel the way they want to feel when they put themselves forward.
Awesome.
So it's a medical clinic, but.
Awesome. Let's give it up. Medical clinic, 30,000 women. Yeah, girl. All right, who's leading from the front here to introduce themselves? And my friend Paige is going to help me out. All right, either one. All right, go ahead.
Howdy, y'all.
Howdy.
And my name is Brandon Owens, and I make people feel dread and excitement about their future.
Sure. Tell us more.
All right, so 1111 is a new startup that changes the global economy in the new age of AI. So if you're thinking dread, you're thinking your job is going to get taken by a computer or a machine, you're right. I make you feel excitement because we've changed the global economy so you don't have to worry about that anymore.
Good work. Thank you. So, we are going to underscore also, fear is a feeling that also works. You're not forced to make people feel safe, to make people feel good. Sometimes you're acting because people feel what? Afraid, right? Sense of urgency. Great work. All right, who's over here introducing themselves? All right, Torian, I tell you, this front row is hot and hopping. Come on up, friend.
Hello. Hi, my name is Torian Johnson, and I make people feel seen and heard by creating digital and physical spaces.
Helping people create digital and visual spaces?
Making people feel seen and heard through digital and physical spaces. Yes.
All righty, tell us the name of your company.
So one of the companies that I'm founding is called Third Place, which is a concept in urban design of places where you can go, gather, work, or just hang out and socialize. And so our goal is to build more third spaces in a lot of cities where those kind of spaces have been overlooked and haven't been built well.
Perfect. Thank you. Underrepresented communities, places, and spaces.
Yes.
Thank you. Awesome, awesome. All right, we got one more to go on this side. Y'all are like, okay, there we go. There's my friend. Come on up.
How many people in here have kids or grandkids? That's quite a good percentage. I know how to make kids excited about school. But not only make them excited about school, but increase their retention by as much as 750%.
Oh.
And also be able to enable them to a whole class, virtually no student doing worse than a B nationwide.
Let's give it up. Look, I'm buying what you're selling, and I don't even have kids. Thanks, Craig.
Thank you. Here you go.
Good stuff. All right, friends, so here we're going to go. We got 20 minutes. Rapid fire into the 4-step process. The purpose of our opening and grounding time together was to really influence your mindset. What matters most when you leave here as a lifelong learner with lots of connections, lots of actions, is that you hold yourself accountable to making sure that your relational elements of your business are sharpened and that they are as fantastic as they can be. Fantastic is a word that means some things to others, something to someone else. How many people kind of resonate with fantastic? What other word would you use to describe sharpening your mindset to achieve results? You need to be what? Focused. You need to be fantastic. You need to be focused. What else you need to be? Say it again. Curious? Okay. What else do you need to be? Confident. Driven. The other thing that I want to introduce before we get into the next steps, there are things you are trying to express in the creation of your business plan and the piloting in your sales and marketing materials. There are things and meanings that you're trying to convey that do not exist. Do not limit yourself to the words or the meanings in the dictionary. I checked in last night. Anybody else staying at the Omni? I'm the only one. Oh, there we go. A few others. I opened the door and I saw something that my 8-year-old niece would get really excited about. It was a piece of art coming from the wall. I sent Lila a picture and she goes, "Auntie, that's so cool. You're staying at a hotel that loves unicorns." I then sent her a picture of what was on the wall underneath the unicorn. Who wants to take a guess of what was there? An explanation of what the word unicorn means in investing. What is a unicorn in the investment world? What's a unicorn? A startup that receives $1 billion, valued at $1 billion? Valued at $1 billion. A startup that is privately held? Privately held, that is valued at what? $1 billion. Eileen Lee coined that term in 2013 because there was no word to describe that. That's somebody I want to talk to again. A creative thinker that's pushing beyond the nomenclature that's used, that's introducing me to constructs and concepts as a lifelong learner that's new and different and unique. I want you to give yourself permission as we step into our 4-step process to think about the unicorns. I don't know everybody's industry. I don't know your product. I don't know your plan. What I do know is that you're copying other cats. And some of the cats you're copying don't even have kibble to eat. You're copying other cats. Now, there's one thing to say, well, I'm stepping into a space where I'm following the proven frameworks and the methodology and the information. And y'all, all of that is great. I'm a huge proponent of data. I'm a huge proponent of frameworks. And as a teacher, when I am talking to my students at Penn State, I force them beyond the measures of the data. Because you've got to ignite your imagination. So the first thing is we're going through the steps. The first thing I want you to do, this is going to be kind of deep. I want you to figure out how your product, how your approach creates a shared moral identity for you and your investors. That social identity will referenced morals and values to an extent. If you looked at religion, if you looked at faith, but there's some universally held morals and common denominators about how to do and be good. And I want you to name your investor something. Do not call them an investor. Who wants to be another frickin' investor? I want you to think of something that they can only become and be by investing in what you're selling, and invite them to be and do that. Everybody else is saying, hi, I want to talk to you about investing in my company. Think about it differently. Introduce something unique. Introduce the same construct, but introduce a moral identity. Is there anyone who's already adopting this construct of a moral identity? There is a woman over in the UK who has really coined this concept. Jen Shang is her name. And a lot of what I'm introducing and sharing is really tied to the psychology behind, even when we're doing transactional things in business, people want to feel good about what they're doing. The 10+ return, that's a given, right? What are you doing above that? All right, friend, you're doing something somewhat tied and connected to the moral identity?
Oh, yeah,
Introduce yourself and tell us a little bit more about it.
Hi, my name is Stefan Brunner. So I'm dabbling here in the startup universe for over 10 years. So I started the co-founders meetup in 2012, which is still going. I'm part of the Central Texas Angel Network, and I do a lot of volunteering at the various schools for guest lectures, as well as pitch reviews and pitch events. And what you just said just resonates me. A lot of people say, hey, you are like an angel investor, give us money. Right. But what I really want is I want to be part of you. I want to be part of the idea. I want to provide my feedback and feel some excitement. Thank you.
Thank you. I want to feel excitement. You can give that in a way that another possible collaborator or a competitor is unable to do that. So I want you to define the moral identity. The second thing, when you get your slide deck, I want you to spend some time reading this. It's going to tell you a little bit more about what a moral identity is. But here within Friends is where we're focusing on the positive feelings. A moral identity is going to be tied to things like compassion, generosity, nobility. It is A-okay for your product to activate feelings of fear, right? Uncertainty. That actually may purchase, it's a nudge for purchasing. Oh gosh, I'm afraid that crime is rising. So maybe I do need to purchase the safeguard. Maybe I do need to rewire my home with added surveillance. A moral identity does not create fear. It creates community. Nestled within community is the unity. It unifies, it connects. The other thing, and we've done a little bit of this, when we break, because we're breaking, right, Ryan? Yes, in less than 11 minutes. When we break, you're going to be up. I'm going to look around, people that you haven't had a chance to talk to, And I want you to have some continued conversations like, hey, have you ever thought about this moral identity thing? Or now that we've been introduced to this, how are you thinking about it? Right? I want you to pose questions so that other people can share insights so that you have a sense of what they're thinking. The second step in our 4-step process, after you've defined a shared moral identity, you are then going to enlarge ROI with value powered by values, right? The value is powered by values. How many of you have adopted values? Good. What are some of the values in your company?
We don't ever pay anybody 11 times more than the lowest amount.
Wow, that is impressive. Parity is one thing to say you're driving for, but to have a concrete way in which you introduce the way in which you fairly compensate people. So give us the formula once more. You don't pay people.
Yeah, we're looking for equitable distribution. Every employee is an owner. The CEO or no one can be paid more than 11 times the lowest paid worker.
11 times the lowest paid employee in the company. That's the max. Exceptional. What else are we doing to enlarge ROI with value-powered values? Because you know what that says to me? When Gordon was like, while you're out raising money and being the chief fundraiser, meanwhile, things might be going this way, this way, this way, you are safeguarding against the tank. You are creating a culture where your employees feel valued, and there's transparency in the fact that everybody's grinding it out, and nobody is out performing in an inequitable way in the realm of compensation. Exceptional. Anybody else doing anything connected to values? Yes, introduce yourself. And I think, yep, all right, here we're coming. Thanks, Paige. Thank you.
My name is Lily, and I have several companies in the travel industry. And one of our values across all of the companies is make it meaningful. And we interpret that broadly, but one of the things that I always tell people is meetings, right? If we have too many meetings, what is the meeting here to do, and how do we make that meaningful so that we can distill it down or replace it entirely?
Girl, you're speaking my language. Make it meaningful. Be a good steward of limited resources. Time is money. Make it meaningful. Thank you for sharing. The third step, so I'm going to go to the third step because we're running out of time, but when you get the deck, this is going to give you a little bit of reasoning and rationale behind why it is important to punctuate values. The reputation of a company serves as a foundation for building trust and credibility with investors. I mean, for those of you who are really only caring about what the investors think, and you really don't think they care about things other than money, even though we've heard from one of them that they do. Investor Hub will also give you some insight on why it's important to create a foundation that's built on trust and credibility, and how that positive reputation not only attracts new investors, but it retains the existing ones. Remember when we were looking at the Capital Factory at the start? They've got a 4.6 out of 5, 300 plus Google ratings, and the vast majority of people want to come back here again. They don't need an acquisition strategy for new customers, because guess what? They're keeping the ones that come in, right? And so we want to make sure that we are thinking through how we integrate values. So when we break, you all are going to make sure that you're connecting and talking through the lens of values. The third thing, and I love Adam Grant for so many reasons. How many folks are familiar with his research? It's so incredibly helpful for me. It's about human behavior. You know those humans that you're hoping will buy your product? those humans that you need to invest in your product, those humans that you hope will come and work at the company where you're selling a product or a service, those people, if you're focusing so much on the technical and you're starting to realize, well, these questions have really made me uncomfortable today, that's a great thing, y'all. I want you to lean into the relational elements. I also want you, whether it's audio, you're walking around town, download Give and Take. Why? Helping others drives our success. There's some really interesting segments of this social science that's nestled in the business world, so many that I couldn't pull them all out. But I want you to accelerate your growth by being a giver and not a taker. Does anybody want to self-identify as a taker? I mean, no. We all want to be givers. There's another construct in this book called matchers. And matchers are people, it's like, oh, I'm going to do unto you as you've done unto me, essentially. And the givers are positioned squarely where they need to be, even when the investor says no thank you. Because how are you going to act? Does the relationship end with the no thank you? If it does, you've missed the opportunity. There is a reason why someone looked at what you were proposing and did not see value in it. That doesn't mean there isn't value. You will eventually demonstrate and showcase the value, and the most empowering gift you can give yourself is to go back to someone who once said, I don't see the value, and thank them for the feedback, and showcased how their feedback led to your ability to increase the value, right? So it is never an end if you view it as a relational connection. It is only an end if you're looking at it from a transactional angle and you're looking for the response of being, yes, I want to invest at this moment. Here's a little bit more about the takers, the matchers, the givers. When you break, start asking people, how are you showing up as a giver? What are you gifting your co-founder, your team, your consumers? Make sure someone else's wins is also helping to include and increase your success. The fourth thing I want you to do is learn what matters more than money. I mean, I love money too. What you don't know about me and what I didn't disclose is that I have a tech startup company too, even with Ruffles, right? And what was the most exceptional thing about the Tech Accelerator program that I just wrapped? My co-founder and I, another woman, you know, we won the People's Choice Award in front of 4,000 people at a Blackbaud tech event. And guess what? We're not in tech, right? I have a product officer and a chief technology officer. I've worked and watched inefficiencies for 30 years, and I know what doesn't work, and I know how to solve for it. And how many of you feel like that's the case with what you're selling? Yep. I'm going to leave you with this, and then I'm going to wrap to tell you where you can find me. In the sector that I work primarily in, philanthropy, which lots of amazing, compassionate investors also invest in charitable organizations, and the only ROI they're hoping to see is the eradication of problems. So much so, billionaires have said, I am willing to pledge half of what I own, half of what I have to charitable causes, right? If you don't know about the Giving Pledge, take a look at it. We're at year 10, but I say all of this to say, Investors are investing in things beyond startups and entrepreneurial ventures. Get to know them as people to learn what they care about and to learn what they're investing in and how your product and how your service aligns with that. I'm closing out with the deal. I forget what they call the word. My mother would be very disappointed as a school teacher. There's something when you have the first word and it makes a word. Does anybody know what? Acronym? Thank you. Somebody else said moniker? Okay, so we got some smart people in the room. When we break, I want to know what it is. But here's the deal about sealing the deal. The 4 steps that I gave you form the word deal. Define shared interests through a moral identity. Enlarge ROI with value powered by values. Accelerate growth by being a giver, not a taker, and learn what matters more than money. I'm going to turn things over. This is how y'all stay in touch with me. My first name is Tysley. I was born after Cicely Tyson. I'm like Madonna. I have no last name. Find me at Tysley@Tysley.com. Link up on LinkedIn. I'll turn things over to my friends. So proud of y'all and eager to champion your success. Thanks, guys.
All right, y'all. Hope you had a good morning. We're going to break for lunch and get back here at 1 p.m. We got a bunch of investors coming in this afternoon to keep the show going. Have a good lunch. Yeehaw.
Well, come with me. We're gonna do some. Yeah.
Mic check. Mic check. Mic check. Check. Testing. Mic check. Testing. Testing. Okay. Mic check. Testing. Mic check. Mic check.
Yes. So you see the first slide kind of is the objective is to help them optimize fundraising. And the idea is that they give a little bit more empathy for how VC works so that they understand when they pitch, not to pitch to some people who are not or who want to invest because it's not
Mic check. Mic check.
but we're going more into
Mic check.
construction that they understand hopefully that
Mic check. Mic check. Mic check. Mic check. That's not
it's not a fit because it's not going to be one extra turn for the fund. So
1, 2, 3. 1, 2, 3. 1, 2, 3.
I have a twin brother. I love to play. Tell me I'm wrong.
So is that something that's usually in there?
I think.
Yes.
Testing, testing. Okay, this sounds good.
Mic check. Mic check.
Yeah. Like it was earlier. Testing. What's up, Nicole? Testing, testing. Ooh. I did turn it down. Testing, testing. Mic check, mic check. Mic check. This is mic check. Mic check, mic check.
Mic check.
Mic check. Mic check. Mic check. Yeah, it's not working.
Mic check. Mic check.
Mic check. Can you hear me? Mic check. It is?
Mic check. Mic check. Mic check. Mic check. Mic check. Mic check.
Mic check. Mic check.
Mic check. Mic check. Mic check.
Mic check.
Hey, Paige. Mic check. Mic check.
Just tell this one that it's very.
turn it on by pressing the button. And then
And I'll do the organized thing.
okay, we can turn it off. There you go.
Can I keep that? Or?
Test.
Thank you.
Test. Okay. Test.
Hello, can you hear me? No? Yeah, can you hear me? Thank you.
I don't play nice in the sandbox.
Welcome back, everybody. Hope you enjoyed your lunch and are ready to rock and roll. We are going to dive back in and get started. So this next session, VC Unplugged, how firms raise capitals. VCs are fundraising too. We're going to hear a little bit about that. That's kind of an important aspect, to have some empathy for your investors and understand what they're trying to do. It's similar, but not exactly what you're trying to do. But yeah, this will be a candid conversation with some top VCs talking about raising their funds. Let's go ahead and join me in welcoming Aram Matar, Brent Kelton, and Nicole Claros to the stage. Welcome, everybody.
Thank you. Is it me or? It's not me. Okay. Hi everyone, and you're in for a big show today. She's telling me she's 40% and 60% show, so.
It's usually my fault, but this time it's not my fault.
Ram's beatboxing.
So I'm just going to spend 5 minutes to tell you why this is so important for you to understand. Before that, my name is Aram, and I'm a former investor, but now I'm not investor anymore, so I can say whatever I like about VC. So, and I'm sure that my two guests as well. So I'm the founder of the VC Factory. Mostly what we do now is research on VC decision making, right? So I'll take you on a journey inside VC's minds today, and hopefully with our two guests. And our objective for this session is to help you optimize your VC fundraising and understand why you have to be intimate with how VC works behind the scenes. Yesterday I was at an event, and I can tell you the amount of time between shaking the founder's hand and the pitch starting, you can't even measure it. It was 20 milliseconds, right? They don't know what I do. I'm not even, by the way, I'm not an investor anymore, so please go and see Brent and Nicole after the session. I invest in VC funds. I don't invest in startups anymore. So they don't know, and you know VCs are trained to read signals, and when you do that, when you start pitching and you don't ask questions about the person you're going to pitch to, it's poor salesmanship. So I'm thinking, if you like this with me, you like this with your clients as well. And at the other end, we had two founders who raised hundreds of millions of dollars, and they were super intimate with this stuff. They understand how to pitch VCs, how it works behind the scenes, and so on. So that's what we want to do. I have a few slides. And before that, I want to know, can I get a sense, who here has raised funds with VC firms before? Like not friends and family, but with VC funds. Okay, so about 10 people. Okay, so it's going to be interesting for all of you. And as I said, I want to take you inside the VC minds through the angle of the mechanisms of VC funds. And I want to start with this quote that I love. It's the first book written on VC 25 years ago, so we know this stuff. People know about this stuff. These are the two best researchers from Harvard on VC at the time. And what they tell you is the way that private equity funds and VC funds work and the way VCs make money impacts what they invest in and how they invest. So this is what I'm going to tell you. Hopefully you know about it. If you don't, it's something you really have to master. But the first thing you need to understand is VCs are like, I don't know if you know, like Greek mythology, but like Sisyphus, he got punished for something horrible he did. So every day he had to take this rock up a mountain, and in the night would come down, and then the next day they had to come up, right? And I think that's what VCs do. They're always doing these four things. They're raising funds, deploying money, monitoring the companies, and exiting. And depending on what they're doing, you may have a shot or not. For example, and we'll talk about it because Brent, for example, just they closed the third fund. If you go and see a VC when they don't have any money from the first fund and they still haven't closed the second one, they're going to ask you a lot of questions. They're going to be super nice with you, but they're never going to wire money. And then you're thinking, why aren't they committing and so on? So you should ask them. You should ask them, hey, how are you in your fund deployment? Are you raising the next fund? Your investment in my company, is it going to be in the next fund and so on? This has a lot of implication on the way that they make investment decisions. So as I said, VCs also raise funds. They sit in the middle between people who have ideas and no money, you all, startups, and people who have money but no ideas, limited partners, right? And so VCs pitch a strategy that's very precise, because the diversification is done at the LPs level. So VCs, they go to LPs, just like you go to them. They pitch the team, they pitch the investment thesis, and we'll talk about two great cases right now. And there's this thing I want to talk about today. You have to understand this term portfolio construction, right? Which is what's the fund size, what's the average ticket they invest in, number of deals, and this has a big impact in the decision they make, and I'll give you an example in a second why they pass on even something that for you looks like a great opportunity, but they're going to pass. And I just want to say that tomorrow you are in for a treat because Mike Maple Jr. is here, and he's one of the people who made that famous, this sentence, your fund size, your strategy, and you have to think of portfolio construction. So he's here tomorrow. So I really encourage you, if you're here, that to go and listen to him. And last slide, and then I'll shut up and ask questions to smarter people than me. I want you to understand an example of everything I said is you have a great proposition. You go to a VC, you're selling them a $1 billion exit. They're convinced, you have traction, everything, but they're still going to pass. And then people think, oh, VCs don't like to take risks. They don't get it. It doesn't work. So I want to tell you why that happens. It happens because if you're a VC with a $100 million fund, you're going for top 25% performance compared to everyone else, because that's where you can raise the next fund, okay? So you want a target multiple on invested capital of 3x, okay? And what we know, right, from the power law, which is not a bug, it's a feature of VC, the power law. It's not the law, actually, it's a statistical reality, that if you want to do a 3x on a 100 million fund, at least one of those investments has to return the fund, has to be a fund returner, right? Has to do a 1x, okay? And let's assume that because of everything we'll talk about in a second, reserve strategy, diversification, and so on, they make an investment, a $3 million investment in your startup, okay? They need that investment to make a 33x. So now you come to them and you say, hey, because of my valuation and the amount I'm raising, you'll get a 10% ownership. And I'm thinking as a VC, okay, but that 10% is going to be diluted over time to 5% because we're going to raise a few more rounds to get to an exit point. And that $1 billion exit, that looks super convincing, that's $50 million. But wait, I have a $100 million fund. So that's returning 0.5x the fund. And I'm not going to do that because I don't know which one is going to be the fund returner, but what I know is if I don't try and get the fund returner, I'm not going to get it. So I'll pass. I'll pass on this great opportunity with perfect founders, perfect market, and everything, but just because the ownership / exit doesn't work for me, doesn't move the needle for my fund. Okay, and with that, I would really, really encourage you to meet VCs as early as possible when you don't need them. And it's a meeting where you don't speak. It's a meeting where you ask questions. You ask them everything I said. So what do you invest in? What kind of momentum are you looking for? What kind of returns are you looking for? And you get an education, and hopefully in 6 months, when you see them again, and in the meantime, you send an email on how good you are and how much progress you did, the decision-making will be faster. And that's it. I'm going to just shamelessly plug my website where you have a lot more information on that. And I want to go to the panel. And hopefully, we're going to go into more details on what I've been talking about. So why don't we start with you, Nicole. Can you, elevator pitch style, pitch your fund?
Sure. My name is Nicole Glaros, and I have been in venture capital for probably almost 25 years now. I was a very early VC in Colorado, and we have a large portfolio here in Texas as well. So the name of my firm is Matchstick Ventures. We are currently almost closed with our 4th fund. It's a $75 million fund. We invest at the seed and the pre-seed stages for tech. So we don't do restaurants or anything like that, but we tend to do early stage software at the pre-seed and seed level. I'd love to go into portfolio construction, but it feels like we should continue the introductions because we literally just did this exercise on how many positions, what size checks, what kind of returns we expect out of those investments. So.
Love it, love it. And so before we do that, Brent, do you want to
introduce
Ventures?
I'm Brent Kelton, with the general partner and Texas leader from Moneta Ventures. And a little bit unlike Nicole, we did not spend our career in the venture space. Our team has worked together for, some of us, almost 28 years, but we spent almost 15 years of that time building and selling 2 companies. Those were in the software and software services space. So we launched our firm in 2014. We completed raising our 3rd fund earlier this year, and so we're deploying out of that now. And we traditionally have been purely seed stage investors, but with this fund, it's quite a bit bigger fund. We're doing seed and A, and we'll probably do 1 or 2 Series B investments out of it, primarily investing in enterprise software, B2B SaaS, for the most part. Some have some hardware component, but primarily software.
So I feel like you both really talked about your investment thesis. And by the way, that's how VC fund pitch to their LPs, right? That's just like you pitch your activity. Is there anything else you want to add on your investment thesis, or shall we go to portfolio construction?
I can add a little bit on the thesis anyway. Is our firm primarily focuses between the coasts, so we don't do a lot of coastal investments. We do the occasional one. And as you will learn, investors they hate exceptions when the exceptions don't work out, but they love exceptions when the exceptions do work out. So when you make an exception, you have to be really sure it's going to work out. But one of the reasons why we invest between the coasts is because we believe that it's less expensive to run companies here, so you need to raise less capital. And also the valuations are a little bit more reasonable here than they are on the coast. Although COVID has changed that dynamic a little bit, we're seeing that dynamic go away as investors from the coast are willing to write larger checks into companies that they've never actually met in person. So you're seeing a lot of them play more centrally in the United States. So while that non-coastal thesis has been our bread and butter, it's on rocky roads.
What I was going to add is very similar. For us, one of the reasons we started Moneta Ventures is when we launched our second company, it was in Sacramento, California, and we quickly found there's no startup ecosystem in Sacramento and very little fund activity there. And so we were also kind of focused on underserved markets for venture capital. So, we primarily invest in California, but not in the Bay Area. So it's really focused more on the Sacramento region and in LA, and then in Texas and around Texas. So we kind of operate out of two headquarters, one in Sacramento and one here in downtown Austin. And then the other thing that I was going to mention is, we raise money too. So, this conversation today is a lot of times I think a lot of founders don't realize that, we do exactly what you do when we're raising a fund. And a lot of the things we have to do that is very similar to what you guys have to do around storytelling and knowing our, potential LPs and the way we pitch to them. So.
And going even further than that, you are also entrepreneurs. So you do the same thing. You try and get your product market fit, you try and get the funding, that's one thing, but then you try and reach enough startups, try and win those startup deals. So maybe you can talk about that a little bit. Is the entrepreneur part of that job?
Yeah, I'll take a stab at that. So we do have to raise money, and it actually looks very, very similar to what you have to do. But primarily, I'll get companies that come up and tell me about their business. And the truth is, I have probably heard your pitch 150 times before you have given it to me. And you maybe know of one or two other competitors in the space, but you don't know of all the people that aren't advertising. We actually face that same thing. VCs sound boringly similar when you look at their pitch decks because we all say the same thing. We have our own special markets. We've got the best deal flow. We've got this unique deal flow that nobody else has. All the VCs are swimming in the same pond. If you were a VC and you had really unique deal flow, you would have no other VCs in your deals. This is not true, right? We all try to make ourselves sound like special little flowers so that these LPs, these are investors, will write us checks, just like you have to make yourself sound like special little flowers. The reason that I'm telling you this is because one of the things that works extraordinarily well as a venture firm is when you're talking to when we're pitching, we have to talk about how we're different than everything else in the space. You also have to talk about how you are different. If you just say what you do, you will sound like everybody else in the space that's got the same sort of market that you have. You have to really lead with why you're different, and we have to do that same thing. Otherwise, it's literally I was at a pitch meeting 2 weeks ago, and I walked in, and they had, I'm not kidding, on the stack of the floor, they had this tall of pitch decks, printed pitch decks from all of the other funds that had been in before us that day. Right? And so you have to stand out in this pile of decks. So we have to do that too.
Yeah, and I think I would just add, you were talking about, we're also running a company. There's a management company, we're entrepreneurs. We have budgets, expenses, goals. So, I mean, we're also running a business. We think one of the things we think is a little bit different about Moneta is that our whole team, have been founders. We have been operators. And, we think we can, really bring some of that experience to the investments that we make.
So if the investment thesis, for me, is kind of the culture of the fund, and if you know that culture and can pitch it back to the VCs, they love it. I think they really appreciate that you did the job. Let's go now into VC math. So Nicole, since apparently you did it recently, can you explain to us, how you think about portfolio construction, which is all these elements we talked about, the fund size, average tickets, ownership is probably very important. Can you explain for your fund and also explain why it's so important for founders to understand that?
Yeah, maybe I want to just back it up and break it down a little bit for a second. So who in here has a retirement account? Yeah, okay. So do you have one stock in your retirement account? No, that would be pretty dumb, right? You probably have, maybe you invested in a fund or the S&P 500 or maybe a whole bunch of stocks. You didn't do one thing. You did portfolio construction inside your investment account. That is what that is. Actually, your investment account, if it's like a 401k or something like that, is actually got some concentration in it because it's probably all in the public markets. So we do something called private markets, which do have some correlation to public markets. So what that means is when the public markets perform a certain direction, our private markets also perform the same direction, right? So a large asset allocator, a person that's got like hundreds and hundreds and hundreds of millions of dollars, billions of dollars to deploy, they're thinking about this thing called portfolio construction and asset allocation in detail. So they might say, hey, we want 20% of our portfolio in the public markets. We want 15% of our portfolio in infrastructure. We want 20% in credit. We want 15% in private equity and venture capital. So when we go pitch them, we're operating in this 15% venture capital private equity market, okay? So when we as VCs do the same thing to you guys. So we just can't invest in one company. Well, we could, but that would be really risky. And the likelihood of us returning our fund would be very low. And if we don't return our fund, we are out of a job. But not only are we out of a job, it actually negatively impacts the whole industry, because if your fund fails, it brings down the whole VC fund stack, which makes these larger investors up here less likely to invest in VC, okay? So we all kind of want to see each other win, yet we're all competing as well. But so our portfolio construction looks like how big is our fund? How many checks can I write out of that fund realistically? How much money do I need to hold in reserves? So everybody know what a reserve is, right? Who doesn't know what a reserve is? Actually, that's a terrible question. I'll explain it. So if I write you $1 million, is that the last money from me? Or do I have any money that I can continue to invest in future rounds? That's called reserves or follow-on, right? I probably have something called a pro rata right, and it depends on whether or not I want to execute it. So if I have a $100 million fund, how many companies do I think I want to invest in, at what check size, for what ownership, and how much money am I holding in reserves for those follow-ons? That's the math part. Part of that has to do with how cocky I am. How good do I think I am at picking winners? The earlier stage the fund, the greater the risk. The greater the risk, the more investments you want to make, the more diversified you want to be. So that means you want to have more positions in your fund. The later the company, the less the risk, because it's closer to potential exit, you can have fewer positions in the fund, okay? So for early funds like us, I'd be curious to know how many positions you guys are going after, but we have a very large position count in my fund. We're targeting 35 core positions, okay? That's actually a big number. So, and we have a $75 million fund. And that number has two things that go into it. One is how much time I have. Literally, like, limiting factor is my time. How many boards can I sit on? How many meetings can I take a week? How many companies can I truly help? How much time does it take me to due diligence, okay? And the second thing is how many shots on goal do I need to make in order for me to know that I will have a winner in there? And we came up with this number 35. It's not 30, it's not 40, so we're like hedging our bets a little bit, and who knows? Okay, please God, let it work. So that is in essence the math. So so by the way, because we have a $75 million fund and we are investing in 35 positions, like Aram said, I need to make sure that every investment that I do has a potential of returning to me $75 million. Most likely, 80% of my portfolio is going to go to zero. So that means only 20% of those positions are going to do anything. Of those 20%, probably only one is going to get a 75. If I invest $1 million, it's going to get a 75x. If I get a 75x on one position, my fund still fails. I am still a failure because I'm put up against the board against public markets. Public market does about 8 to 9% a year, right, on average over time. But I'm a long lock capital, so the investors can't pull their money out. So I have to beat 8 or 9%. In fact, they're looking for somewhere between 15 and 25%. Some will say 30%. That's crazy. Those are big numbers for us to reach. So if I have one company that 75x's, I'm still a failure. I need 3, or one that 200x's and another one that like 5x's or something like that, right? So most of the positions are going to go to zero, unfortunately. So when I'm looking at you and I'm looking at your deal, I'm not going, is this entrepreneur awesome? Although I am thinking that, right? I might love your deal. I might love your company. I might love you, but the math might not work for me to invest. It's not the right fund. It's not the right tool, right? And it's not a vote on you. It's not a vote on your company. It's a vote on the deal. But too many founders get wrapped up in like, oh, they didn't like me. I'm like, no, that's not true. It's the deal, right? So when you understand that math, I think if you actually put it in a spreadsheet, you can really start to see, oh, wow, these guys have a really hard job. And we do when we're not drinking cocktails on a beach somewhere.
And can I piggyback just before we go to Brent that many founders think, oh, what I'm offering is a 3x, you remember, or a 20x, and that's great. They're going to make a lot of money. I'm doing the work. Like that's what founders say that. But Nicole's example is perfect. 75x, and you're still a failure. So that's why you guys have to understand that because you're selling a proposition. You're saying, this is my ownership, the ownership I'm giving you because of your valuation, because of the amount you're raising and your valuation. So when you ask for a high valuation, that's a trap, right? Because you're going to give them a low ownership. So you need to have a huge exit so that Nicole can do her 200x. So you really, really have to think about what they're going through. So,
yeah, Nicole, you covered so many great things. I'll try to fill in a few gaps, and give you some examples from our perspective. So, we started our first fund. We invested in 15 companies, and our sort of model for fund modeling and how to do that has changed so much since then. First off, we thought we should do at least 5 of them in B2C. B2C's got to be, a great area to be in. And we quickly learned that our entire team has spent all of our career in the B2B space. And that was, a big lesson learned. And we also had successfully built and sold 2 companies in our whole career after spending a little bit of time in management consulting in the software space. And we thought nothing should fail. We got to be able to, every company we invest in has to succeed, at least to some extent. And sometimes we spent too much time on companies that just were not going to make it. And for a whole number of reasons. It could be, everything from the idea to the founder, the market shifted. So, those were too big. And then the reserving, we pretty quickly, our first fund was a $25 million fund, and we ended up having 2 sidecar vehicles to invest more in our best companies that we had to go out and raise to make it a total of $45 million just to be able to do that. So, big lesson learned was let some things fail, spend your time on the ones that have the most promise, and reserve enough capital to bet further on your best company.
Or don't. Let's chat about that for a second, right? So one of the things that we've learned at the pre-seed and seed stage, it is still, so remember, my job is I have to return money to my investors. It's not philanthropy, right? And I fail unless I can generate roughly a 3x to my investors. So if I've got a $100 million fund, I need to return $300 million. And if I don't do that, I will have a hard time raising my next fund. So every money that I'm investing, I'm thinking hard about, am I going to get that back? What happens in the reserve scenarios is, especially at the pre-seed and seed stage, there are so many things out there that are going to kill you, your company, not you. So, well, that too, but so many things that are going to kill your company. And the younger the company is, the more factors exist. And the truth is that we don't have a lot of insight yet as to whether another dollar in is a good investment or a bad investment. We have a saying, good money follows bad, right? And so when we write the first check, usually it's write the check and pray, like, God, I hope this works. And we all think it, and then we really get to know what you're capable of doing after that first check. What ends up happening 8 times out of 10, and I'd love to know if you've experienced the same ratio, is that you don't do what you said you were going to do because there's so many things that can go wrong, and we end up in a save the company position. So that means you've run out of money, you haven't made the progress in order to raise the next round, you go back to your existing investors and you say, please bridge me. Now I have money in reserves for you, but remember, I have to decide, I have to return a fund. I have to 3X this fund. So I'm looking at you going, is this gonna really save the company? Like, is this company gonna like 100X from here? Or is this money better in another company or in another position? And so while your whole world is wrapped up in this decision on whether I save the company with my follow-on decision or my bridge decision, what's going on in the back of my head is this money better returned somewhere else? And man, that's a really hard thing, because you know what? After working with you for a period of time, I've gotten to love you, I've gotten to know you, I want to see your hopes and dreams succeed, I want to see you win, and I really don't think you're going to be able to. And so I make a pass, which kills your company, and you blame me forever. But the truth is that you would have done it too when you're looking across your investments and you're like, I've got a little bit of money, what do I do with it in order to generate the best return? It's so hard to separate this emotional state from the returns, because this is your baby, and like, I understand that, and I want to help you win, but I also have to do the right thing by my LPs.
Yeah, and the way to relate it back to your decision when you approach VC funds, you should know about that. Like, is there just strategy to not have reserves, put everything in the first check, maybe not spend too much time with you because they're doing 50 investments, in a year, and they're going to be hands off, which is not the right VC for those of you who want someone who's going to spend time with them and maybe, as Nicole was saying, accompany you over time. You need to know those things, and this is easy questions you can ask. Not at the beginning of the first meeting. I would wait until the end of the first meeting. Yeah, so, what's your reserve strategy? What's your, how are you planning for launch? Do you do them? Because there's not one truth in VC. Like, we used to think that when you have a winner, pile money in it, but it depends on the valuation of the next round, it depends on the market, it depends on many things. So there's not one truth, and VC firms have different answers to those problems.
So do you guys save? Do you like save per position, or do you have a pool of capital?
More of a pool.
More of a pool?
Yeah, not necessarily per position.
Yeah, so what that means is that like they take their money, they take their reserve capital, and it just sits in a pool, and then they make individual decisions with each company. Other firms will say, nope, we reserve 1x our original investment for that company. So part of your job as you're like fundraising is trying to figure out what their reserve strategy is so that you can go into the first check understanding if there's more money for you or not at a later stage.
So let me ask you, Brent, first. Maybe the question is, you just closed your Fund 3. Congratulations, because I don't know if you know, this is a very hard market also for VC funds to raise money. So is that the best moment to talk to you? And if you generalize on other VC funds, when is the best moment for founders to approach VC firms? Is it right before they close the fund, right after?
Yeah, that's a great question. And for us, first you kind of have to know, we have really 2 funds. We have kind of what we call a regular fund, and then we have an SBIC fund, which banks invest in. So it's a licensed fund. It's licensed by the SBA of the federal government, and that we have bank investors. And that fund usually takes a little longer to get approved and get your license, and you can't do a close with investors until it's approved. So we're always, when we launch a new fund, we're raising and closing on a rolling basis in the main fund while we're working on the license process. So for us, we start deploying, we'll start doing some deployments out of the main fund after we do the first few closes. So to really specifically answer the question, there's never really a bad time to talk to us. I think our kind of approach is if you're within our, thesis, we want to talk to you as soon as possible. Even sometimes when they're at the pre-seed stage, because we really, and it's again, back to when we're raising funds, like in this fund, it's the first time we really raised some more true institutional dollars and more from banks. And on some of the bigger ones, like we heard right from the beginning, well, you should have been talking to us in Fund 2, because our standard policy is to spend an entire fund cycle getting to know you quite well before we write a check. And so some of those, unfortunately, will be maybe a Fund 4 for us. So same with us with founders. We want to get to know people and hear about your idea and what you're doing well before you fit, our check size. And for us, that's about we usually come in at $1 to $5 million in a seed. And just to give a little bit of a contrast, Nicole, this fund is a $252 million fund, and we'll do about 55 or so investments. So we're doing bigger checks because we're a little bit later stage, and then we have a pretty significant reserve for follow-ons. So,
But wait, your fund is 255 million?
252.
Oh, 250 million. Oh, so how much money does that fund have to return?
Yeah.
$750 million. So they're going to write $1 million check in you. How much money do you have to generate? What's that multiple on a $1 million check for 750? So how much ownership does he have to have in the company, and what exit does that company have to have in order for him to write that check? It's huge.
Yeah, or if you have 10% of the company after it's diluted, you have a $7.5 billion exit.
So you do the math, though. You're like, oh, we're creating a veterinary operating system for vets, right? And I go online and I'm like, look, it's what all the exits in the vet systems, and most of that stuff's exiting for 150 to 250 million dollars. I can't make my math work. I pass. This is really important for you to understand. His ownership amount and the size of the check relative to his fund size helps you figure out if he is a good target for you. And if he's not a good target, save your breath, because your time is valuable too, as this is.
And the answer is not to say, you come with a $1 billion exit, the answer is not to say, hang on, give me 48 hours, I come back with a plan with $7.5 billion exit. That's never the answer. You need to find another VC whose thesis works better. So maybe last question, because we want to keep time for your questions, so get ready, because as you see, they tell you how it is, so it's rare in VC, so you should take advantage of it. So maybe, Nicole, we can start with you. What is the thing that you tell most founders about that you're tired to repeat all the time, and that you can record, and then hopefully after this session, you can send them the video? What is the thing that fundraising founders are doing wrong that you want them to do right?
Don't raise VC. I'm actually not really kidding. There's only a small percentage of companies out there that are appropriate for VC. Most are not. Most of the time, founders want to raise money because they want to just do the thing faster. Like, I want to quit my day job, I want to focus on this full time, I want to go a little bit faster. That is not a good reason for us to invest. Also, you are selling your soul. Your business probably isn't a good fit for VC. Go back and really do some soul searching and do some math before you decide you want to go that way. And then when you go that way, you've got one type of company that you're going after. One type. And if you don't see yourself in that role, don't do it, because you're literally selling your soul and you will make yourself miserable. So that's usually the thing I tell people.
Yeah. Yeah, and to add a couple other things that are really tactical, I think, just know who you're pitching, know their thesis, know if you're a fit. I think lots of times we get people reach out that are just clearly not a fit, and we have our thesis on our website. I mean, it's pretty clear what we do and don't do. And then just basic things, keep your message really crisp and clear. When you're in your formation stage, keep your cap table as clean as possible. There's just lots of times, for a lot of the things Nicole said, I mean, we're not just looking for a reason to say no, but there are a lot of things that are red flags and that will quickly just make us say no.
So someone told me, a fundraiser once told me, the best meeting with the VC is the first one, because after that, there's only reasons to say no. So I can be provocative a little bit as well. So I open it to questions. Okay, cool. So gentlemen on the second row.
Thank you. Thank you for your honesty. It was really very enlightening. Now, one of the questions I have, I agree that there's a certain X that you've got to hit, but it's also based on an assumption of a valuation that you think is going to occur in 4 or 5 years. And that's that thumb thing where everyone does the hockey stick and everyone discounts the hockey stick, and we sit in that loop forever. If we had good comparables, yes, we'd be able to provide that. But almost 80% of the time, you're shooting out into the ozone a little bit. So how does an entrepreneur solve the valuation expectation?
And just for time, we'll have maybe one of you answer, and then we can go to another question. Do you agree? Yeah. And if you can keep the questions brief, like as with you pitching, that's great.
You don't. I mean, that's my honest answer is you don't. I'm going to do my own homework, and I'm going to go out and look at what's reasonable, what I believe is possible relative to the exits that are out there and the dead bodies along the way, if I can find them, right? I'm going to do as much homework in that, and I'm going to put a number on you. You can put whatever number you want in your deck, and I am probably ignoring it.
Yeah, we're going to adjust it quite a bit.
So, does someone have the mic?
Yes.
Okay.
So my question is about your investment thesis. So you're promising your investment thesis that you go to your LPs for is very specific. Does the terms of your contract with your investors prevent you from investing in things that are adjacent but not identical to your investment thesis, or is that fun?
It can vary. I think there's probably some funds that are set up that are very strict with what you can and can't do with LPs. There's a little bit of flexibility, I think, in ours. I mean, obviously, if we went out and said we're going to start investing in farming, or in China or something, there'd be a big problem, I think, for our LPs. But
one thing you should know is how much does the team have committed of their own money in the fund, because they probably have more leeway.
I was going to mention that, and for us on our fundraising, that's a big help. In our first fund, we were just the partners in the firm were 15% of the fund, and in fund 2 is about 10%, a little bit less in this fund because and that makes a big difference. I mean, and I think the other thing I was going to mention too is that Nicole touched on but didn't specifically say that it's very important for, I think, founders to know that, like, a lot of people don't understand is, like, we as the partners in the firm and the firm in general really don't make money unless you guys succeed. Depending on the size of the fund, I mean, the fees we get really just barely cover our expenses and our team. And we're a fairly lean team. We have 16 people in our firm, but I mean, we're working for the carried interest, which is a percentage of the profit above what we return after we return everybody's initial investment. So.
Yeah, if it's a small fund, they're broke.
Yeah, no doubt.
They are broke. So not all VCs are, driving super nice cars. If they're driving a super nice car, one of their funds, probably not more than one, did well.
Next question.
I want to talk to you a little bit about regulation, SEC regulation, specifically FINRA, which, if you don't know, means Financial Industry Regulation Association, and they do things like license and regulate broker-dealers. And, fund exceeds a certain size, then it has to register with the SEC. Can you address, the differences between funds that have registered broker-dealers and those that don't, and funds that are registered with the SEC and those who don't? What do startups need to know about that? And do they need to ask those questions specifically?
I don't know any VC firms that are registered.
Yeah, I mean, look, we pay very expensive attorneys to make sure we don't have to be registered with the SEC, so I don't actually know how to answer your question.
Yeah, I don't know of any VC firms that I know that are registered.
Right. We're not broker-dealers. We operate under an exemption. We have to follow rules that allow us to operate under that exemption. We have very expensive attorneys telling us when we're getting close to violating it. So we do not operate that way. I don't know any VC that does.
So we have one last question because we're out of time.
Yeah.
Hey, thanks. So my question is a little bit about, of that fund, you know, the 75X, I'm guessing is like the pre-seed or, you know, I'm guessing that return kind of, you know, expectation lowers as you get into a seed or an A. Somebody that's proven the concept that, you know, has put some skin in the game and maybe they have a successful history. Maybe they, you know, have proven the product market fit. And so with your fund, you know, what percentage of it are you putting toward, you know, the A round bets compared to the seed bets and the pre-seed to kind of maybe hedge, you know, and then just kind of on the flip, how much does the person behind it, their history, how much skin they have in the game themselves and, you know, just, yeah.
Yeah, great question. First off, I mean, number one, I think talking a little bit about founders. I mean, and you know, we get pitches by founders that what they're pitching to us, they're kind of doing on the side, and they're working another job. So first of all, we look at founders, this is all they're doing. They're completely in. And then as far as like percentage of the way we look at the bets we make, like for us, definitely the largest number of deals we'll do will be seed rounds. And again, those are generally 1 to 5 million. For B rounds, those will be 3 to 7 million for us. And so obviously we'll do quite a few fewer of those. I think we'll probably end up doing 6 to 8 A rounds. We may only do 2 B rounds, but they could be up to a $20 million check. But you're right, the risk level definitely, in theory, goes down quite a bit.
The risk goes down, but the math doesn't.
But the math doesn't, yeah.
The math doesn't move, but the risk, the mental risk goes down. So if all things being even, I'm going to invest in the founder with a lower risk, but the math still is the same.
On the total fund, you want to see the 3X, but
Yeah.
on the A round investment, you might not be expecting 75X on how you are. Or the B round, but I guess.
Well, it depends
So
on how much you
can we
invest.
continue this after? I want to thank Nicole and Brent and the whole Capital Factory team. Thank you so much. And if you're staying here, I'm sure people are going to jump.
Thanks so much. Yeah, thank you.
All right, thank you all very much for that session. Very insightful. We're going to take a few-minute break. We're going to get set up and have a fireside chat with David Zachariah from Synsize. So hang tight.
Testing.
We're going to get started in about 1 minute, so if you want to continue your conversations, please make your way to the atrium. We will rock and roll here shortly. Thank you.
Testing, testing. Testing.
All right, y'all, let's start getting settled back in. You don't want to stop the conversation. I want to encourage you to have them outside. Brian from Minetta has an absolute fan club following him outside right now. Thank you, thank you, thank you. Look good? All right. All right, we're going to dive in to our next session, which will be a recording for Capital Factory's podcast. Who's listened to our podcast before? You go. Thank you, thank you. Check it out. Spotify, Apple Podcasts, YouTube, wherever you listen to podcasts, search Austinpreneur, search Capital Factory, smash the subscribe button. And listen, but you're here live, you're going to get to hear this episode first. Very exciting guest we have. Our guest is the founder and CEO of Sensei, which is an Austin-based AI diagnostics platform that uses eye tracking computer vision to make mental health conditions more visible and treatable. David began his journey in science very early. He was selected in 2012 as one of the 100 Google Glass pioneers, so he's one of the first people to start developing in Google Glass, and he was a recipient of an Office of Naval Research Award for DNA computing research, and he built Sensei out of a high school science fair project. That's about the point. I met David, and we invested through Capital Factory back in 2017 initially. Moved him here to Austin, and he's been crushing it. He's raised a lot of money. He's sold his soul, according to the last panel. I own a little bit of it, but it's we're still friends. He seems to like me. It seems to be working, and we're doing some badass shit. So yeah, Sensei's work sits at the intersection of deep science, regulatory compliance, and real-world development, turning lab research into commercially viable product in a heavily regulated environment. In today's conversation, we'll dive into how to raise capital for ventures where milestones span lab results, regulatory standards, and real-world pilots, and how to design a capital stack that supports those long-term hard tech trajectories. In other words, how do you do something that's never been done before and expand the human envelope? So without further ado, let's welcome David Zachary from Sensei to the stage. Up? Yeah. Thank you. Have a seat. Welcome. Don't block my logo.
I always paid a lot of money to get the Topo Chico logo into the shop.
That's right. Well, they are one of our partners here. AC Ventures, shout out. All right, well, I'm going to ask some questions. I've got some hard-hitting questions for David, but then we're going to turn it over to y'all and hopefully have a good bit of time for Q&A. That's one of the hallmarks of the Capital Factory podcast, is it's really where the audience is a big part of the discussion, and we compete with all the other sessions that happen here at Capital Factory for leaving the most time for Q&A. But yeah, without further ado, David, let's just introduce us to Sensei, what you're working on, and then we're going to dive in from there on your fundraising journey.
Sounds great. Well, hi everyone. Thanks for coming. Done a couple of podcasts, never live, so this is going to be fun. But I'm David. I'm the CEO and founder of Sensei. We're a 22-person startup based here in Austin. Our office is literally across the street. And essentially, the problem that we're working on solving is the fact that within the mental health space, there's really no objective or accurate way to do anything whatsoever. The way that we kind of describe the current standard of care in behavioral health, the way that we diagnose and manage mental health patients is essentially the equivalent of diagnosing someone with diabetes but never measuring their blood sugar, which, as ridiculous as that sounds, is the way things work right now. As much as we talk about mental health as being this invisible thing, it's really not. There's been functional MRI after functional MRI study that has shown that the way a PTSD brain versus a depressed brain versus a bipolar brain and so on and so forth respond to stimuli is actually very different. So there are objective and accurate ways to both diagnose mental health conditions as well as see how they're changing in response to different things. The issue is just that there's not a scalable and accessible way of doing any of those things. And so what ends up happening in the real world, about 80% of all mental health is diagnosed and treated exclusively inside of primary care. And it's essentially the equivalent of you show up at a doctor's office, they ask you a couple of questions, on some sort of a patient self-reported questionnaire. It gets diagnosed as anxiety or depression. You get SSRI or an SSRI or Xanax. That's kind of the end of the road for the overwhelming majority of patients. And even if we want to suspend disbelief for a second and say that these patient self-reported questionnaires are 100% accurate, which they're not, but let's just say they are, the bigger issue is they can only screen for anxiety or depression. And so everyone ends up diagnosing positive for anxiety or depression. We have this big chronic anxiety and depression population that we think it's just getting worse and worse, where in reality, the overwhelming majority of that chronic anxiety and depression is undiagnosed or misdiagnosed something else. And so that's really the problem that we're looking to solve. And at our core, we're building the first diagnostic and severity monitoring platform for behavioral health. And our initial focus right now is on PTSD, anxiety, and depression.
Excellent, excellent. Well, noble mission, no doubt. Now walk us through your fundraising journey and hit the high strokes of the various rounds you've raised and go from there.
Can you see the first part of that again?
Just walk us through your fundraising journey. I remember you won the $100,000 Quit Your Job Challenge by Capital Factory. I know that was our first check, but yeah, like in your mind, talk us through. I know it's probably like never-ending fundraising journey, but yeah, lay the groundwork for us.
Yeah, so we just closed our Series A about 2 months ago. So I think I have a much better understanding now of how to raise money or really how not to raise money. But we've the Sensei fundraising journey has been very long and very difficult for a couple of reasons. I think there's a lot of ways that Sensei doesn't look like any other tech company that kind of turns it off from a lot of kind of traditional software investors, because even though we are 100% software, the outcome in many ways is binary. It either gets FDA approved or not, and so a lot of traditional software investors don't like that. But we also haven't really fit the mold of a lot of the traditional medical device investors, because I'm not an MD, PhD, and our team looks more like a software team than it does a traditional medical device team, and also the amount of money that we have to raise to kind of get this across the line is a lot less than most medical devices because it's 100% software. So we've I wouldn't say like fundraise the way we fundraised, but I can obviously kind of talk about the way it worked. So we kind of, very early on, we did like a small angel round, and that basically started from Capital Factory. So we got like a $100,000 check from Capital Factory back in 2017. That ended up becoming part of like a $2.5 million round that we did. And back then, the focus really wasn't on mental health yet. It was kind of on just trying to build the core technology and the platform behind what we were doing. And on a very simple level, the way the product works, it's essentially eye tracking. So it's about a 10-minute test on a mobile phone. we show different types of ocular stimuli on the screen while we videotape your eye's response to it, and then we can deliver a diagnosis and a severity score on the other side of that. And very little behind what we're doing is new from a scientific standpoint. Almost all of this has been known for 30, 40 years now. The problem has been you've traditionally needed a couple $100,000 worth of eye tracking equipment to make this work. And so our breakthrough is more that we've been able to use computer vision to do all this on a smartphone instead of a very large expensive eye tracker. So for the kind of early fundraising rounds, we were kind of trying to find deep tech investors that can kind of make the leap in their heads that if this works, it'll be really useful for something. But we didn't really know what it would be useful for. And so we raised kind of an initial, $2.5 million or so. And we started to kind of try and just chase different applications that we could find on the marketplace people had for eye tracking technology to essentially try and get grants to kind of continue the development of the core platform. And then our big break that then led to kind of unlocking actual fundraising. So in early 2018, back then we were kind of 4 people, and so we worked upstairs on the 16th floor. And I had kind of strategically positioned myself and became friends with a lot of the Capital Factory staff. And so whenever someone important was in the space, I got the opportunity to pitch Sensei to them. And there was an Air Force general who was here for a tour one day, who was the commander of the Air Education and Training Command for the Air Force. And he basically wanted to know if it was possible to use this to track a more objective way of understanding if student pilots are learning how to fly a particular task correctly, because his idea was if you can help us more objectively understand if people are learning, I can train to proficiency instead of a certain number of hours. And so, like any good startup does, we said yes without having any idea if it was possible, and we would figure it out as we went along. And so that led to kind of a 2-year rather large Air Force contract that we got. And there were some things that we had to deliver to the Air Force that for the most part it was kind of funding a lot of our kind of core R&D just to build out the eye tracking platform. And so throughout that we got it from like a very expensive $10,000 large camera down to a form factor of like a pair of glasses you can wear inside of a flight simulator. And so off of the back of the Air Force contract, we kind of were able to raise like our first proper seed round. Capital Factory invested in that. A couple of like smaller venture capital funds invested in that as well. We kind of pulled together we put together about 8 million or so, I want to say. And we raised that on a safe. We were never ever really able to just pull a whole bunch of investors together, and so we just kind of we went as we could, and we had faith. Like there were times where, yeah, exactly, rolling close. There were times where we had like $2 in the bank account, but we had a good feeling an investor was going to close, and it just kind of worked out. Which $2 in your bank account is not so bad when you're only 2 or 3 people. It's a lot scarier when you're 20 people, and we can talk about that later.
It gets way lower than $2.
It gets way lower. I know a lot about how big of an overdraft the bank will actually let you do.
It's wild. Yeah, you can get pretty far down there.
Yeah. And then in early 2020. The technology was working. We got the science behind the eye tracking through a peer review. It was working on a phone, and then it became time to kind of figure out exactly what we wanted to apply the technology to. It was smack in the middle of COVID at that point, and so obviously, the subject of mental health was being talked about a lot, and there were 3 different things that happened on the commercial front that kind of led us to get to the decision that the mental health application is the one that we should kind of go after. And so at that point, we settled on that. We raised another round in kind of late 2020, early 2021. That was about $5.5 million that we raised from our existing investors, because for a couple of reasons we just couldn't really attract much cash at that point. And then that led to our Series A that we raised we closed it about 2 months ago. It took us about 2.5 years to raise it, and I'm sure you can kind of tell me how much details kind of walk through that. But yeah, that's kind of been the overarching history, and we closed that Series A about 2 months ago, and is roughly $20 million.
Excellent. There's a few things I want to double click on there that's very important. When we first met David, there was no for sure that this was going to work. He was for sure about it, but he was a high school student, just graduated from high school, working on this, but I distinctly remember saying that even if it doesn't work, this is the type of guy we want around here. Like, this is the type of thing we want to work on and go after. And by having something that's so ambitious and something that a lot of people would call bullshit on and say, that's not true, you can't do that, you're creating the mentality that is exciting for an investor, that can create the type of returns that are fit for VC funds. I think that was a big learning lesson for me early on, and yeah, I think it's worked. The government piece can't be understated. One, when that Air Force visit was like the first time the Air Force came to Capital Factory, and they were looking for all this deep tech stuff, and we had like David to show them. So it just goes to being early.
AFWorks wasn't a thing back then. Like this was like all pre-AFWorks, pre any of the government stuff at Capital Factory.
That was right. That was right. Before Army Futures Command and any of this, yeah, David was really the first company that I think had a direct engagement. Maybe Firefly or some others, but that's a common denominator, and really it's almost. I mean, there's a lot of SaaS companies that raise money these days. We're not super hot on it here at Capital Factory. It's these deep tech companies that we think are very exciting. Some others, Sensei is one of them, Apptronic, Saronic, Colossal. These are all unicorns that are here in Texas in our portfolio. These are exciting things. These are hard problems. Pretty much all of them, they augment their financing strategy with non-dilutive capital. It's a very important piece, and it really makes it attractive to investors. It's usually not the government coming in and saying, I'm going to fund this ultimate platform that's going to be a billion-dollar, trillion-dollar product. It's more like your technology aligns with the capability roadmap they're going after, and they can fund a part of it, a component of your system, or they can fund some tests that get you data that you need. And then you piece a few of those government contracts together, and all of a sudden you've really chopped off some technical risk of the ultimate platform you're trying to raise money for. And then that's very attractive to investors. And then there's also later stage programs where we're putting in a lot of money, largely because we know if we go put $800 million into Saronic, and the U.S. Navy's looking for a big new shipbuilding company that's got a lot of advanced tech. Like, there's no other company that has advanced shipbuilding with $800 million in their bank. Like, that's a great, not for sure, but like a pretty good chance they're going to get that business. So I think that's another key piece of this conversation is just, being able to, align, and sometimes you got to zig and zag to accomplish these early stage deep tech milestones, because it's really hard for like an angel investor and a lot of seed funds where it's like, I got to raise even relatively small amount. He's raised about $30-40 million. It's still like that's a pretty big risk to take as an investor. So if you're able to get some of the government funding to de-risk that, I think it helps a lot. So. All right, moving along. I mean, so what were your breakthroughs from a narrative standpoint to investors? I mean, I know there was a lot of investors we probably put you in front of that just didn't get it, and maybe they weren't the right fit. But when you were pitching this big moonshot vision, back when it was not nearly as common to hear a pitch like this in Austin, what ended up working in your memory to get some of those early seed, any other early investors or even the Series A investors?
Yeah, it's a great question. So I think it's two separate answers for the different groups. What ended up helping very early on was actually kind of, and I think a big part of it was because of the investors that we were pitching, and if I knew what I knew now, I think we would have gone after different investors. But we really didn't focus, it started working when we stopped focusing on the science and the technology, and just kind of would tell them that we can prove to them it works in due diligence if we got to that point, and just really focus the pitch like a typical software pitch of talking about the market and the application and how much revenue we can make and all of that. And that early on, that seemed to work. I think what really helped us on the later stage of our financing, so like our Series A, the last kind of 2.5 years, so I'll head back. When we first kind of started to raise the Series A, there were a couple issues we were running into, some with what we're doing and some just kind of like general dynamics in the market. The mental health space, if I was really smart, we would have raised a giant round during COVID, because there were many companies in the mental health space that raised a lot of money during COVID, and most of them don't exist anymore. And part of the problem, there were kind of two categories of companies. There were a large number that were doing telehealth, and there was nothing new or unique. It was just kind of, there were a couple hundred telehealth specifically for mental health companies or for mental health conditions that got funded in that time. And a lot of the larger VCs that had backed them were just kind of turned off to the category because they just poured a whole bunch of money in, at the height of COVID at ridiculous valuations, and a lot of them just did not exist. And granted, there were many spaces that the same thing happened in, but that was kind of one issue. And then there were, 2.5 years ago, there were roughly 40 companies that were trying to do mental health, not diagnostics, but trying to quantify mental health in some way, shape, or form. Of that 40, there's 2 of them that are left. And I have a lot of opinions, obviously, on why what they were trying did not work, but that was the other issue is everyone else was kind of convinced that they can build some sort of a screening tool instead of a diagnostic and not take it through FDA. And a lot of investors were excited about that because they could be on the market, 12 months. We were saying we're kind of 4 or 5 years because we got to do phase 1, phase 2, phase 3
Cutting corners.
trials. Yeah, and the thing is, it's not, if there was a market demand for it, it's not really cutting corners, right? Because but what we were very convinced, and it started as a gut feeling, and now we've kind of validated it, that because there's nothing in this space right now, the only way to actually change the clinical journey of patients, and by that the outcomes of patients, is to establish a real gold standard. And the only gold standard in this space is FDA approval, and FDA approval with the word diagnostic, not as a screening tool or a support tool or something like that. And so we were very, very stuck and immovable on that. And so raising money was it's a lot harder to raise money saying you're going to build a diagnostic when you have no data versus 6 months ago when we finished our phase, so we finished our phase 1 2 years ago, our phase 2 roughly 6 months ago, and now we're starting our phase 3. And so as we got more and more data proving that the science and technology was working, proving that the FDA was receptive to what we were trying to do, and then there's really no analog to what we're doing in the commercial world, which in a lot of spaces, including in ours, in a lot of spaces is very exciting because there really is no competitor. But the way the healthcare world works, your customer and who's paying is different, because our customers are the providers, they're the providers in the health systems, but the insurance companies are paying for it ultimately. And when you do anything new in the insurance world, there's no CPT code, and so there's a whole other process to actually get payment in place. And so as we've kind of been able to slowly tackle milestones along that, that's kind of what has assisted us. But we haven't really, I wouldn't call Capital Factory a traditional VC, and the couple of other VC investors we have, VC, I wouldn't really call VCs as well. We ultimately have never been able to kind of crack the code and make Sensei fit the boxes that a VC has wanted to raise, and so or would want to see to invest. And so most of the money we've raised has either been from non-traditional VCs. This last round we did, our Series A, was led by a large corporation where they're kind of, us working helps their a business that they're trying to build, and so there's kind of a lot of strategic alignment there. Or we also found a lot of success with high net worth individuals and family offices, because a lot of the questions that we get from VCs was kind of prove to me that doctors actually are going to use this and this and that, but if you either yourself or you've had a kid who's gone to rehab or has any type of of serious mental health issue, you might not know exactly how to fix it, but you very strongly have seen firsthand what needs to happen to kind of change the mental health system. And so we found a lot of success with those types of investors. And I know it sounds very morbid, but I literally I did a ChatGPT search rich people with mental health issues, and that became our target list, and we went after it that way. And it sounds very weird, but there was very obvious alignment of anyone that has firsthand experience with this system is going to understand the problem, and that seemed to work really well for us.
So, as Gordon says, hyper intersected investors in your space. So we're going to open it up for questions in a second. So if you have a question, raise your hand. Nicole will bring the mic around. But I would just rephrase what you said, around the breakthrough, and it's something I've seen a lot of, and it's one thing to have the vision for a great product, and that will get attention. The other key thing that maybe isn't that I see missing more often from a founder's vision is the go-to-market strategy, right? And it's what's your creative approach that's going to allow you to bring this to life? With David, it was becoming the gold standard, getting FDA approved, and really sticking to that approach. And yeah, and that's something that is very important. One, because obviously you need to kind of know how you're going to do it. But two, it needs to be creative in the sense that if Elon wants to compete with you, you can still win, right? Or it's defensible. It's something that when you are successful, people are going to come after you, and they're going to try to take your market share inevitably. And you need to have this way to enter the market and kind of lock the door behind you. I think that's a key piece. So it's not just what are you going to do, but it's what's your creative approach that's somehow special to your unique advantage, your unfair advantage that allows you to become successful. So who has a question for David? Who's got the mic, actually? All right, great.
I just wanted to say you're really inspiring and super incredible what you've done, and congratulations on all your hard work. I think it's a super important space that you're in, and appreciate you being here. I just wanted to know, how are you incorporated? And also, do you have nonprofit status? Because you had mentioned grants, and I thought that was really interesting because I'm also thinking in that space of going both Delaware PBC and having a branch of nonprofit. And also, did you had VCs? Yes, but it wasn't all angel investment. I'm sorry.
A couple, yeah.
The quasi VCs, maybe not total traditional VCs, but.
So are mission-aligned VCs, do they really exist where it's not just about the revenue, but also the mission alignment? And did you experience that in all of your investments where they care just as much about the mission as much as the revenue?
Yeah, that's a great question. So I'll move backwards. I think so. In terms, so I think there are certainly a lot of VCs that are mission aligned. I think in my experience, and there's one that's invested in Sensei. I think in my experience, they are it is true they can be equally invested in the mission. However they choose to define it, as they are in the in the commercial and return side of things. But what they're expecting on the commercial front is not any different than what would expect if they were not mission aligned. So the mission alignment kind of is more of their thesis, but their LPs are still expecting them to deliver a return the same way any of the other funds that they're invested in would. And so the one mission aligned VC that we have, the founder had a very public bipolar episode, and so he started this whole fund, and all they were investing in at that point is mental health. He's had to expand since then, only because there aren't that many quality mental health deals, in his words, and so he's had to kind of expand to other types of investments as well. But yeah, the fact that we were mission aligned got us in the door, but his due diligence, both in science and the kind of underwriting that they did, was I think the same as kind of any other fund. He still wanted a 10x, 100x return and all of that good stuff. to answer your first question, we're a Delaware C Corp, like just the all the standard vanilla stuff. For the government grants that we've gone after, corporations are eligible. There's certain grants that we've had to go after where like at least 30% of the work needs to be done. By a nonprofit, and so we've either partnered with like a traditional nonprofit or partnered with like a with a academic institution. But yeah, we're just Delaware C Corp.
Hi, I actually participated in a clinical trial. I didn't ask what was the TRL, so don't look at my results. So I'm assuming that you, because of your description, that you applied for an SBIR. Was it for NASA? Right, STTR.
Yeah, so we've done a couple of SBIR and STTRs. The ones we've done have been with the Air Force, NIH, and the Army.
So mental health is a huge issue for space travel, and I mean, mental health is one of the priorities that NASA is trying to resolve. So for those of you that don't follow space, they have fake space trips, and they go and pretend to be in space. And so the analog astronauts actually have had scuffles and things like that. Obviously, you don't want people fighting in space. But so NASA was not on your radar, or is that like a new information for you?
Yeah, it's a great question. It's not new information, but with the exception of the Air Force, and this is changing slowly, but all of the SBIR and STTRs are topic specific. So you can only really propose something if there's a topic for it. And so yeah, in all the ones that we've seen from NASA, there has not been like a mental health topic that we've been able to apply to. But if there was, yeah, we certainly would be interested. I'm sorry? Okay. Thank you.
Interesting. Nicole is picking, so I don't know where's the, all right, here we are, yes.
Hi, you've clearly got a number of different investors and VCs involved. How are you or they defining success with Sensei? You know, obviously coming in at different stages, some are going to be looking for revenue, some are going to be looking for FDA approval. You know, how do you manage all those different, success metrics that they are looking for?
Yeah, it's a great question. So I would say, obviously the time horizon is slightly different for some of them just based on when they invested. But I think they all define success the same, which is they would like an exit for the company at kind of, 30 to 100x what it was when they invested. And like for us to kind of get to that point, it's kind of FDA approval and then a certain level of revenue after that. And so actually, I think we are pretty well aligned with all of our investors. Exactly when we would look for an exit and this and that is not really a conversation we're even kind of having right now. So we're expecting, if everything goes well, we can get FDA approved on a full diagnostic towards the end of next year. Is what's kind of most likely from a timeline standpoint, and then there's probably kind of 5 years of work on the other side of that before that type of exit's possible. Just because, like in healthcare, you get FDA approval, there's then a whole bunch of other nonsense you have to work through for kind of to get to kind of the type of revenue numbers we would want to see. But yeah, I think everyone's kind of on the same page of FDA approval, start to generate a large amount of revenue, and then kind of exit after that.
Thanks so much. Really awesome what you've done. Just question on the professional and technical legitimacy that you had to build at the beginning. Did you do that primarily from other team members, co-founder, advisors? As you said, straddling software and medtech is difficult. You're not MD, PhD from Harvard or something. So what was your strategy there, and how did you build that in the early stages?
Yeah, so we did two things. Before we started any of like our clinical trials or anything, we did build a medical advisory board. And we kind of reached out to like all the top professors in the psychiatry space. And we got very lucky that there aren't like unlike cardiology and like a lot of other areas, they're not really getting contacted every day for like companies that are working on things, and so we were actually like it was relatively easy to put that board together. Like the top psychiatrists in the country, if you depending on the Google search, the number 1 or 2. It's a guy named Dr. Charles Nemiroff, who's the endowed psychiatry chair here at UT Austin. He was at Emory before that, Miami, Duke, a whole bunch of places. He's been doing this so long that the psychiatry chair at Harvard Medical School is his former student. Like, so you can imagine he's an older guy. But we just kind of cold emailed him. We got on a call with him. He ripped us apart for 25 minutes, and at the end was like, "But okay, like I'll do your advisory board for you." And then he helped us kind of like craft the rest of it together. And then when we actually started our trials, we found like who the best investigators and scientists are in the space, and we kind of we did our best to convince them to be the investigators on our trials. And so at this point that like we like our phase 1 trial was 68 patients, our phase 2 was roughly 750. We have done like a big machine learning training study that is wrapping up right now, but when it's done it'll be about 13,000 patients, and then we're running a 2,500 patient phase 3. And so the fact that we have studies of that size now with like from a publication standpoint, they're like our brand name investigator names on them. That's kind of like where a lot of our credibility in the scientific world is coming from now.
It's an interesting idea having software teams approach medical problems. It's something I think a lot of our most interesting companies in healthcare are doing, and it's like a bit of a leapfrog approach. So it's interesting. I mean, una más. All right.
Hi.
Madeline. Hi, Madeline.
So David, you shared with us that it was difficult to raise traditional VC early on. You're doing something truly novel. The lane that you're in has a high regulatory hurdle. It's a long time to market. And Nick already mentioned you leveraged non-dilutive capital, but you also found a different application to generate revenue. So a different application of your tech to generate some revenue along the way. I guess kind of a hypothetical question. That may have taken some focus of the team to work on those different projects or different applications, but you own more of your company, of the equity currently. What do you think your trajectory would look like? What would be different had you been able to raise traditional venture earlier, easier?
That's a great question. Yeah, I think if we were, it's a mixed bag. Because I think like if we were able to raise like honestly a proper round of funding like in 2019, 2020, the company might not exist now because I don't know that we knew exactly what we were doing, and we probably would have just gone to shit.
In general, those deals from 2020, 2021 are not doing well.
Yeah, and I think like it's one thing it's one thing to like not quite hit a milestone and need more money to raise a milestone. It's another to like have a failed clinical trial and then try to raise money, because very few people want to. It's a much higher barrier to kind of come across. So if we knew what we were doing and we were able to raise a proper round, like I think we could be we probably could have been FDA approved 18 to 24 months ago. Because the biggest thing that not being able to raise money delayed was like our clinical trials, and we did them in a much slower manner. We started them a lot late. We started them a lot later than we kind of planned to. But yeah, I think that the journey. I mean, we still have a long way to go to like success, but I think the journey has kind of worked itself out a bit.
Everyone join me in thanking David for coming on the Capital Factory podcast.
Thank you. Thank you. Thank you. Let's stand up and take a picture in here.
Thanks, Ben.
All right. Thanks, y'all. We will take just a couple minute breaks, and we are going to dive into our next session very shortly. I think we just got to flip the stage. All right. Sweet. Thank you.
That's good.
Mic check, mic check.
Welcome back, everyone. We're going to resume our programming to wrap up your conversations or don't wrap them up, just take them outside. That works too. But we're going to jump into our next session, Survival of the Fittest, Navigating the AI Playbook. Maybe if I don't say anything, everyone will stop talking. commanding attention. All right, AI is rewriting the rules of innovation, but it's also raising the stakes. In this timely session, local VCs and legal experts from Perkins Coie will unpack the real risks behind AI startups and how to manage them with confidence. From compliance to ethics to investor transparency, you'll walk away with a practical playbook for navigating AI's wild frontier. Please join me in welcoming Dan Austin, Valeska Hintz, Eileen Allen, and Gopi Sundaramurthy. Welcome.
All right, well, welcome everyone to our panel. I'm Dan Austin. I'm a partner with Perkins Coie. I'm in the Emerging Companies Venture Capital Practice Group. I'm joined here by my partner in crime, Valeska Peterson-Heinz, also with Perkins Coie. We've got Aileen Allen with Mercury Fund and Gopi Sundaramurthy with Ensemble, sorry. The way we're going to have the format go today is we'll do about 25 minutes of moderated Q&A, and then we'll kick it out to for some audience Q&A. So get your questions ready, but we'll save those till the end there. So I think I'll start by just going down the line and having each panelist just take a minute to tell us about yourself, your fund, and what you're doing.
I don't have a fund.
You don't have a fund. Tell me about your fund.
I'm Valeska Peterson-Hintz. I also work with Dan. We're at Perkins Coie. It's a large international firm. I feel like we do everything, so we should start with like what we don't do, and I'm not sure what that is. I work with investors and startup companies from Series Seed until they go public. I've worked on over a dozen IPOs and multiple unicorn companies, so I've seen people start things, get all the way through, and all the like bumps along the road, so I love being part of that journey.
Hey y'all, I'm Aileen Allen. I'm with Mercury Fund. We're an early stage VC based here in Texas. And by early stage, we'll go as early as pre-seed all the way through Series A. We primarily look at like vertical SaaS and AI. We do a little bit in blockchain and fintech, and then a little bit less maybe in what we'll call frontier tech. So think aerospace, robotics, and quantum. I joined the firm a year and a half ago as the newest member of the investment team. Prior to that, I spent 15 plus years in B2B software with early and growth stage companies, running a lot of go-to-market, so think growth, marketing, some inside sales. So I bring that lens into the investment team. So great to be here.
Hey, my name is Gopinath, one of the co-founders and managing partners at Ensemble VC, based in Austin. Early stage fund, essentially doing all the way from pre-seed to Series A, invest in multiple verticals, but I think where we've been concentrating a lot more on is areas really impacted by AI, whether it's going to be defense tech, biology, life science, and AI itself. So yeah, thank you.
All right, so what Gopi did not tell you is that Ensemble is not just an investor, but it's also a product company. And so this first question is going to go to Gopi, and I want to kind of get a sense to level set for the audience, because we talk about AI companies, we talk about AI funding, we talk about the risks of AI. What is an AI company?
I mean, it's the question that keeps me up all night, but I'll kind of give you like a high level of how we look at it. So just to give you a little more context on what Dan said. So the way we really approach venture is taking a much, the way we approach venture is very similar to how like most quant companies approach venture. We use a lot of data to identify these companies. And again, the main goal is to make sure that like instead of talking to 100 companies where you go to 1 or 2 into diligence, our goal is to make sure that we can build meaningful relationships. And the way you do that is by using data to say, talk to 10 companies, make sure that 5 or 6 is where you build meaningful relationships in. So our entire thesis has been this. So we've been doing this for about 8 years right now. So one of the biggest reasons why I'm super excited about AI is like literally what it's done for our firm itself, right? So high level, from what I would consider as an AI first firm, right, is a firm that really couldn't have existed in its current form 5 years back. So think of it as any company that's building a tool that really couldn't have existed, whether it's going to be a developer tool, whether it's going to be foundational models, or a company whose product really wouldn't have existed in its current form 5 years back. Those would essentially be AI native companies. Anything that is not that at this point, like, and also I'm going to say this very clearly, like there hasn't been a company that we've looked at in the last couple of years, in the last year to 2 years, that is not what we call as has a flavor of AI built into it. And this is really what we classify as AI-enabled companies, where the processes of what you're trying to do in these firms has been drastically improved by AI itself. And the question is like, what level are we showing a lot of the AI to these particular users, to the customers? Those tend to vary depending on the product, but most of them have been enabled where the process have become streamlined thanks to AI.
Thank you. That is I think that's probably the toughest question I'm going to ask all day, most conceptual. All right, so I'm not a data person necessarily. I majored in history, so forgive me here, but just to kind of set the table for the discussion, I went to PitchBook, and I want to throw out a few interesting facts and figures that I found. So from January through the end of August of this year, here 2025, AI deals accounted for more than 55% of aggregate deal, VC deal volume. So 55% of aggregate VC deal volume for 2025, not capturing September. And then in terms of pre-money valuations, there's a relative parity that we're seeing between, seed, pre-seed companies, and then it starts to shift around the Series A, where we're seeing higher pre-money valuations for AI companies, and then it really takes off in the later stages. So Series D and onward, the average or the median pre-money deal value was 3 times the non-AI companies, right? So if you're an AI company, Series D, odds are that you're 3 times more valuable than a non-AI Series D stage company if you go based on this data. And then moving on, so the top 3 AI deals, that's OpenAI, Anthropic, and xAI, accounted for 73% of all AI deal value. All right, so very top heavy. And then horizontal AI platforms, so we think of like OpenAI, Anthropic, more broadly accounted for 68% of AI deals. So, just some context out there to actually put some numbers around the hype, and there's lots of hype. So, Aileen, I'm going to direct this question for you, since Mercury Fund really focuses on investing outside of the Bay Area and maybe outside of the coastal areas. How would you describe the current AI and non-AI investment landscapes, kind of both here in Texas and then more broadly across the nation?
Yeah, sure. So, thank you, Dan, for clarifying that. We invest across the U.S. outside of Silicon Valley is the way that we frame it. So we look at deals. We actually were funded looking across the central United States, so funding founders who were typically underrepresented by traditional VCs. I would say that 55% stat seems kind of low to me, to be honest with you, but maybe this is just the hype in the world that I live in, where every company I'm talking to is an AI native, AI first, whatever moniker you want to put on it, company. I think I lived in SF for 7 years, so I have a lot of connections there, and it does still blow me away, the valuations that are happening there for the early stage on an idea, like pre-seed, seed. So great founder coming out of insert whatever company you want is getting very, very high valuations. We're seeing that happening, I think, across the central U.S. too. I don't think that's just concentrated in the Bay Area. So met a founder who got 5 on a 35 and was currently still working at another company, and we can't really participate in that, right? Those are really, really high numbers. So I think for the right founder with the right idea and the right market opportunity, they can, they will warrant those high valuations. But, it doesn't mean that we're going to be able to get the ownership target and participate the way that we would like to.
Valeska, your practice, you really sort of balance your practice between Texas and the Bay Area. What are you seeing, or how does that compare to what Aileen may be seeing?
I think it's kind of the same thing. I feel like the Bay Area has always had a lot higher valuations, but then again, you have Mira Murati coming out of OpenAI and starting a startup, right? That is not just any Series Seed startup. So she's going to pull a lot of money that other people wouldn't be able to pull. And I think some of the PitchBook stats that we had looked up, and at the end of Q2, it was dwarfed. I think that's why you were saying it feels like everybody is, because the first half of the year I want to say it was 70%, those big deals. It was 5 deals that just sucked all the air out of the entire VC ecosystem. There was just so many big checks. And if you kind of look at it from a macro level, like a lot of the big funds, like you're looking at, like your Costa Noah, Sequoia, Benchmark, the really big guys, they have like disproportionately bigger funds, and it was a lot easier for them to raise than some of the smaller funds. And so their check size, likewise, has to be really big. And so then that kind of helps with creating these really big valuations, and they invest very heavily in the Bay Area.
All right, so we're going to move on to talk a little bit about, and this first couple of questions are going to be focused and directed towards the VCs on the panel around your approach to investing. Okay, so, I imagine that as an investor, a big part of your job is to kind of look into the future and kind of project or come up with a thesis of what the world is going to look like in 8 or 10 years, then allocate capital according to that thesis. Just given the rapid pace of the evolution of AI technology, how does that impact both your timetable and then how you're predicting successful outcomes? And Gopi, I'll go to you first.
I mean, it's a really good question, right? I think one of the things that we really ask ourselves when we're looking at an investment is, like, why is now the right time for these kinds of investments? So I'll kind of use a couple of portfolio companies as an example as to why and how we pick up companies. So one of the bigger ones that we invested in, again, we don't know how the company is going to do. It's an awesome name, though. It's called Potato AI. Can't get a better name than that. The logo is even better. But the challenge that they're really trying to solve is like a very good example of something that was done manually for the entire time. So I did a PhD in systems biology. For the longest time, my research involved me going to the lab, literally pipetting different combinations of substrates into different experiments and try to conduct these experiments where this required me to sit in the lab for extended duration of hours, multiple combination of experiments. And the only limitation factor as to how many experiments we could do was how long can I stay there, right? And this was not just research in our area, right? This was the same thing happening in physics, same thing happening in every single areas where whether it's drug discovery, drug development, life science, biology, and this is just using an example, the biggest reason was, the limitation was someone actually doing the experiments or understanding what was the sequence of things that needs to be done, translating that to doing right now. So what Potato is coming in to do is the fact that they really think that the way to disrupt this is by taking all these experiments, it's already documented in all these research papers, to convert them into something that is machine readable, that is a robot can read and conduct the same experiments overall. Now, why is this important? Because fundamentally, the way you think of it is like, this will change the way we can do experiments, both in terms of drug discovery, what we can find, how we can find things, and how fast we can find them, right? And that's really what we're trying to look for. Like, what has fundamentally changed right now? Like, whether it's going to be, can I connect the organization data across multiple things that enables us to do things that we could never do before? That's really the outcomes that we're looking at in terms of when we look at a company, how is this fundamentally changing what we did before, and what are the assumptions that are being targeted there?
What about you, Aileen? How are you approaching this problem?
So what are we looking for, essentially, right? Yeah. Okay. So, I mean, I think for us, again, our thesis is outside of Silicon Valley. So industries that are ripe for disruption with AI, and like the speed at which you can innovate and build products. So I said vertical earlier, and by that, like, let me give you an example. One of the companies that we invested in based in Houston, Texas is called Collide. It's the agentic orchestration layer for energy. And so you think like about like oil and gas and some of those workflows, and there's just a lot of opportunity there. And so that's the kind of stuff that we get excited about. Does the founder have, are they subject matter experts? Do they have like a unique perspective and opinion? And I think that's primarily how we think about it, is like, sure, architecture matters and all those things matter, but who's the founder and what's their right to win?
All right, so really kind of boils down going back to people then, it sounds like.
It's always about the people. I mean, that's like the fundamental rule of investing early stage. It's always been about the people.
All right.
At our stage.
Yeah.
Yes.
Just to add to that. So like we have this service with Ian that helps like our companies go through their pitch decks. And he has like a 10-page slide deck that tells them like what they should do for their pitch decks to be introduced. And like one of the top things is like, who's your team? And like explain your team and put their logos on there. So like the investor can look at it quickly and like know like you have a solid team. Yeah.
I mean, it usually just lands up being, why is this founder the right person to solve this problem? And why is he better positioned than anyone else? Because I think it's easy to come up with an idea. Like, again, I keep saying, ideas a dime a dozen, execution matters. And you really want, like, especially when you're building a startup from the 0 to 1 phase, the biggest thing that we look for is, has this person done that? Has this person had the right expertise, the right grit, the right temperament to be able to take his product? Because, and we was having this conversation backstage, like I have not seen a company that started off by saying, in my pre-seed, this is the company I want to be building, and going all the way up to a Series A or Series B with the exact same thing. You have to pivot at least a dozen times or more. Every single time you go in, you have to read the room, you have to read your customer, figure out what's working, what's not. And if you're not able to do it, it doesn't matter how good the idea is.
Yeah, I would say just to like quickly echo that, like one of the things we look for is adaptability within founders, right? So their level of expertise. And when you said, can they do it again, just to clarify, it's not be a founder again.
Yeah,
it's
yeah.
like, right? And
Yeah.
so, yeah, adaptability is the word that comes to mind when I think about like founders and this, like how fast things are moving. Can they move with the market? Can they move with the speed of tech innovation?
How often for you two, like when you like see somebody that like gives you a pitch of like, we're doing this for like our seed or pre-seed, do you see them doing exactly the same thing and not pivoting when they get to like their B round or something?
Honestly, I have never seen one. I'll be honest on that one. I have literally never seen a company. I mean, the broader thesis has remained the same. Like, I think Icon's like a good example. Like, hey, we're going to do this, or we're going to do this. The high level thesis is exactly the same, but the products, how you're building your products, what are you reading, right? Again, like this is where you really see something changing. Like you read the environment, you figure out what's working, what's not, and you adapt so that you're still able to continue your mission. Like the mission, I think, is core. But what you're building, the product that you finally land up building will look very different. And that's mostly because what you had in mind when you went in is not what the customer wants. And you need to figure out what your customer wants and build something that actually adapts to that one really quickly.
So if we're talking about people, we're talking about the human element, then we're talking about risk, which is part of the byline of the panel today. And Valeska, I mean, you work on a range of work with companies at sort of a range of the life cycle. I know you work at a lot of late stage companies as well as you're getting ready to go public. And so you see a lot of the landmines that sort of get planted over time. What are maybe one or two common pitfalls that you're seeing that companies may have or be falling into that they should address and kind of fix now? And kind of by way of background, I mean, Gopi's got a couple of portfolio companies that were worth nothing in 2022 because that's when they were founded, and today they're worth a total of $6 billion, right? So you can go from being very small to very big very quickly, and so some of these risks can really compound if you don't sort of squash them out early. So what are a couple of these pitfalls that maybe you're seeing?
Yeah, so with frontier technology at a law firm, where we're going to see this come out the most is lawsuits, right? And in diligence. And diligence can be like where it comes out most. If you have like a pre-seed investor, a seed investor, they're probably not digging too deep. But by the time you get to like your B round, they're digging pretty deep. And like all those problems that you haven't been fixing or that you've been kind of neglecting, you might get to the point, especially if it's like an M&A deal, then you're kind of fucked because it's going to kill your valuation. It's a little bit too late to fix it. So it's like all those things that we're building up, like, do you own your proprietary code that you say you do? Or like any of your proprietary data? Like, are you using data that belongs to somebody else and they can switch the off switch on that data and then all of a sudden your model doesn't work? Have you agreed to indemnify your customers for a bunch of stuff and there's huge problems? So like that's like the Jack and the Beanstalk problem, right? Where like you send this agentic agent out and you say, go buy me a cow, and it comes back with magic beans. Like that's an issue, right? And somebody's liable for that. So if you've agreed to a bunch of indemnification, maybe you are on the hook for that as the AI agent. Maybe your customers are on the hook for that and they start leaving. So you have these like companies that have churned up really fast and they're like, oh, we have no churn, right? But like maybe all their customers are planning on leaving because their AI agent brought back a bunch of beans. So it's like all these things that like normally you'd have a lot of time to kind of be working with your teams through to say like, we're using AI in this way and these are the risks, let's start putting in safeguards. You just don't have the time for that, so it's much more compressed. So that's, I think, a lot of the big problems.
Well, Aileen, from a VC perspective, I mean, what are you seeing that maybe mistakes or pitfalls that companies are falling into early on?
That's a good question. The one thing I wanted to quickly kind of highlight on
what Valeska was saying, is around the data set. And I think that's something we look for also really early is unique data sets, right? Like not just scraping, not just like accessing LLMs and putting something on top of that. What do you have that's proprietary, or are you building a RAG model? So I just wanted to make sure I could like
Sure.
note and mention that. I think like early risks can be anything from talent and hiring. So that might seem like a softer risk, but like, can you attract the right talent? It's very expensive to get those ML and AI engineers, and that's hard, and that can feel really risky. If you're building AI first, your margins are gonna be very different from the traditional SaaS margins, and that can also seem really risky. You're gonna need probably a lot of more money earlier than you typically would. So there's all kinds, like the word risk can mean a lot of different things, and so I'm coming at it from a different lens and not just from, you know, maybe the legal side, but hopefully that's still helpful. Anything to add?
I mean, I'm just going to echo what Helene said. I think for us at least, when you're looking at a firm, the first 5 hires are make or break, right? I think like this is paramount. Like the founder's ability, especially the CEOs, their ability to make sure they can communicate their vision to attract the right talent is really, really important in the early stages. It matters more than anything else that they're doing. If they're not able to have the right talent to build the right things, I really don't think there's much opportunity, especially in this environment. It is so competitive, right? And it's a lot of times it's like, again, if you're going to expect someone from a very large brand name firm to come and join you as a co-founder or to come and join you as one of the first founding engineers, you really should be able to articulate your problem extremely well to someone for that person to take the biggest decision of their life to come and join you. And I think it's like I said, that really does tell us whether this founder can articulate and show his vision, not just to a customer, but to other people joining them. And I think for us, that has really defined, like the way I look at it, when we are modeling it from a quant side, the key things that we're really looking for is what is the team coming together? Why is this team uniquely built to solve this problem? And it all comes down to the founding team, and that really matters a lot.
So talent, team, people, well, given the sort of the volume of companies and pitches that you're receiving from AI companies, you have to have a way of filtering through that and like separating signal from the noise. When you're reviewing decks or you're reviewing pitches, kind of what's a turnoff? What gets you a fast no? And Aileen, I'll start that question with you.
Oh, that's a good question. Is the founder a subject matter expert? If they're not, and they're like, hey, my friend told me about this really cool thing that we should go solve for, but I know nothing about it, but I know that I'm an engineer and I can build it and I'll make it really cool. And let me tell you how I built it. And if you go in to start launching about like how you built it and not the why, that's going to be a turnoff for me. This goes back to like, can you sell the company to your talent, right, that Gopi was mentioning, but can you sell it to me and can you sell it to future investors? So I really want to know why. So if you're unable to articulate that, that's a turnoff. I said earlier, the unique data sets, like that does really matter, especially if you're building AI native, like what do you have access to that nobody else has access to that will continue to differentiate you in the future? So if you're just coming with, hey, we're accessing the large language models and we're not building anything unique on top of that, that's probably a turnoff. I don't know, there might be a longer list than that, but those feel like 2 safe ones to give you.
Would Uber for anything still be a thing? But no, I'm joking. No, I think it's very much around the same side. I think our general thesis has been, like, especially if you're having teams come together to do something, you really have to understand what is the purpose for this founding team to be there, right? Have they worked on this problem and they have a very good, like, not just like a surface level understanding of this problem. Like, if I push this founder to the extreme, can they tell me something that no one else in this room will know, right? Getting to that point is like the fastest way for us to build conviction. For most of the deals that we've done, the best deals that we've done, that founder had some insight that literally no one else saw, right? And the ability for them to be able to execute on that and say, I have a conviction, I think I can build something really big here because no one else has done this, because I have this, because my experience has led me to this place. That is literally like one, especially on the early stage, on the pre-seed and seed side, that is fundamentally the most important question that we ask. It can be sometimes you can have like a very basic thing where, hey, I'm doing this, or like one of our companies, Lottie AI, was like, I have spoken to enough celebrities to know this is going to be a problem, right? This is not like, hey, I worked in this code and I know this problem, anything else. This is like, I have spoken to celebrities when no generative AI is going to be a problem. I have a better understanding than anybody else as to what it takes to convince a celebrity. And hence I'm building this product, right? That expertise, you just can't go walk down the street and find someone who has that. Not the network, the connections, the skills. Those are things that only come with time. And you have to have those for us to make sure that we can really work towards it.
All right, so I'm going to ask one more question, then we're going to open it up to the audience. So this one may be a little bit tantalizing. And Celeste, I'm going to start with you. What's one widely held belief that AI investors or AI founders hold that they're wrong about?
Sarah, how many of you were around when like mobile was a thing and everybody had a mobile team to like put, okay. Now everybody has an AI team and we don't really need an AI team. We need a product team that integrates AI where people understand it, where it's needed. And I think that's like a big movement. Like I think everybody, like how many people have an AI team right now? Okay, so, right. I think that's going to start changing, and it'll move the same way mobile moved with all these other waves, where it'll be this situation where everybody has a product team and they're integrating AI into it.
Actually, oh, there you go.
Mine is also team and people related. I think there's a lot of concern that AI will take all of our jobs, and I don't really see that. I think we'll have leaner teams. I think we'll have really efficient, lean teams. But I think that people will use AI to augment and to scale themselves and accelerate themselves. I don't think there's going to be this mass like wipeout of people.
I'm going to go a little bit different on this one. I'm going to go more on the AI side, and I'm going to say, like, I do worry about this. I think one of the challenges that we are seeing is, again, partly on the dead internet theory side, but mostly because the amount of data some of these LLMs require to train is just so massive that you are going to see sort of like a plateau being hit in terms of the capabilities of the AI. And unless the fundamental architecture of AI is going to change, what was promised, essentially a lot of times what was promised on the AI front is still some time away, right? Because the true promise was AI can figure out something, it knows what to do, it knows how to do it, it's able to contextualize, sort stuff out, and do all of those things, right? All that is amazing, and I think we will get there, but I think the current versions of how we are approaching the problem, we are going to hit some plateaus on that front. And you're going to start seeing that data is going to become way more paramount as these companies start to grow. And you can start seeing how companies' behavior is going to change in terms of how they can start aggregating unique types of data sets. Not just, hey, I have all the text of the internet right now, right? It's going to go way beyond that. And I think the next frontier is all going to be about how can you just go way beyond that and think about what is the next kind of data we need to be aggregating for us to be able to make those decisions.
All right, at this point, we're going to open up to the audience for questions. Before I do, though, how many founders do we have in the audience? All right. How many investors? Okay. All right, very founder heavy. Questions? I think they're coming around with a microphone. Pick somebody in the far end of the room. That was my bad.
Thank you for picking me. So yeah, as a founder myself, part of an AI company, pretty AI forward with the development work that we're doing. Have a small fund that we gathered from an accelerator program here, and we're ending that program. What advice would you have for AI forward companies trying to differentiate themselves, especially in a heavy market like sales? Because there's a lot of AI sales based agents, Artisan to name a big one that maybe people are familiar with on LinkedIn and things like that, but just any advice or just any thoughts on kind of that space in that market and how to make yourself stand out?
Well, congrats, by the way, on securing funding. I would say, like, who are you? What sets you apart? What gives you the right to win? What's your why? How are you unique and differentiated? You probably know a lot of that, so you've got to lean into it and have like full conviction. So I had a pitch from a founder last week, and they said, "I think we are doing," and I was like, "Whoa, no, you are doing. You got to tell me. You know, like that does really matter. Your landscape is crowded, so like, what really sets you apart? That's the answer you have. Like, I don't know how to give you advice on that other than to tell you like, be super firm on how you communicate it. And as much as you can, have your customers tell your story on your behalf. Like, what language are they using? Why did they pick you? Like, how can you promote that? Because nobody tells your story better than your customers."
I mean, the only thing I would add exactly that one is that like your first few customers that you get are going to be the most important salespeople for you, because they are going to tell you why we use the product and why we didn't use all the other things. And there's no one else selling, because then someone actually doing this work on a day-to-day basis.
For the legal point, like one of the things that we're telling like our customer or our clients that are going out and getting tools, and our commercial contracts people tell them this, is like, make sure that when you're negotiating with them that you get indemnity. That was that whole like Jack and the Beanstalk thing. And so they're negotiating for indemnity, and you guys are saying like, we want to train our models, and our guys are saying like, we don't want you training the models. So sometimes what we've been seeing is they'll say like, if we can train our model, then you get a better price, or you get like indemnification. And so like there's some play there that like people are getting a little bit of traction in the marketplace with. I know that's a technical point. That's great.
All right, more questions? Have a question back there?
Hey everyone, hey Dan. My name is Jasmine Brunson. I'm the CTO and co-founder of Rectify AI. My question for you all is, given all the hype, right, all the trends, how are venture capitalists sifting through the trends to figure out who actually has the viability in the market? A few years back, we saw crypto boom, 2021, and we saw VC just focus on crypto. Now we saw AI boom with ChatGPT launching in October 2022. So I just want to figure out, how do you all go about figuring out who in the market is actually viable versus just following the trends?
I'll take a first stab at this one, and I think I'll go back to the same thing. Like, who is the end customer and what impact is it making on the day-to-day business, right? At the end of the day, someone's got to be paying for it. And if you follow the money and you figure out that if this particular company or this trend or whatever it is able to create meaningful gains, we would look at it. Main reason why we haven't done a ton of crypto is because we just couldn't find it from our side. But for AI, yeah, there is some companies that have made meaningful impact in terms of how they're doing it and what they're doing it. And that's really where we go. Like, one of the things that we do early on as part of our diligence is literally talk to every one of the customers. And we spend like an hour just talking to them, saying, why this company? Why did this matter? Why is this changing? So the biggest telltale sign if something's really working is there sort of like a behavioral change in the customers when they start using a product. The best products will induce behavioral change. And if it's able to do it consistently, like every single time we spoke to a customer and all of them said, hey, yeah, this changed the way I did my work, or this changed the behavior, that if you rip this off, I have to go back into something that was archaic, that is the product that we'll invest behind.
I think that's great. I'm sure we can elaborate on it, but I think that's great.
All right, more questions. We have a question back there.
Hi, I'm J.R. Reiling with the Insurance Collaboration to Save Lives. Question for the gentleman that found that his time was limited, or was the limiting factor in the lab. Can you elaborate more in terms of like how your discovery loop has been automated in terms of being able to use the data that you train your models with to suggest further experiments and then incorporate that feedback?
So you're asking more on the discovery side of the companies, or discovery side of for that particular company?
For the company that your specific company, yeah.
Yeah, so I mean, so the way they look at it is essentially there's a lot of knowledge locked up within literature, right? Everything from, like, in general, the way manuscripts are written is every single data point that's required to replicate an experiment should be part of the literature. That is like a prerequisite when you're submitting it to one of these larger journals, that you should have every data point in terms of how it was conducted, when was it conducted, how many experiments did you run, what was your measurements. Everything should be part of that particular manuscript, including the supplemental and materials and everything else, so that if another researcher in the other part of the country takes that particular research, should be able to replicate it if they follow the steps. If that's true, then everything that you need to conduct this experiment in an automated fashion is also there. So once you start pairing up with stuff like Gecko Robotics, which is essentially like robotics that help you do lab automations, right? you can start converting these into protocols that these labs can then start doing. Again, you can see them at some basic level already existing. The question is, can you go through the entire loop from all the way from experiment to like recording it and doing everything that you want to? Like the analysis, like I'll give you like a good example. Every single time, let's just say that you are doing like a cell culture study, that you finish a cell culture, then you got to take that particular one, identify the one that you want to take the DNA extraction for, and send it to the lab, get the DNA, and then do an analysis. These are like 6 different steps that are there that are all done manually. Let us just say that I'm able to automate this where once I send this out and it comes back and I have the genome sequence there, it's able to do the analysis and tell me what the result is. Saves so much of time from a researcher perspective, right? And that's really what we need to think about and how to replicate that overall.
All right, we got time for one last question right over here.
Hi, my name is Kevin. I'm the founder of Agent Graph, and we embed elite AI engineers into product teams to help bridge the AI divide. I have a thesis that I wanted to get the group's thoughts on. So I think custom software development is on track to get commoditized, but I see a lot of venture capital flowing into verticalized AI kind of SaaS business models. And so I'm curious what you all think in terms of what the breakout will be in terms of business spend. Will businesses start spending more money on hand-rolling custom software, or will they continue to have a large share of spend go into a bunch of different SaaS products?
That's a really good question. I think we'll see a consolidation of a lot of SaaS products. Like we're already starting to see that with some of our portfolio companies where they provide a solution that does like a 4 or 5 in 1, right? So I think some of that SaaS spend will get consolidated, and so maybe that budget allocation then goes towards, additional support on like services or something, right, for engineering. I'm not sure. I don't know. I'm going to be thinking on this question after this, but that's my initial thought. Is like I think we'll see a consolidation play for some of the SaaS budget line items. But curious your thoughts.
I think it's going to completely depend on the company, right? I think this is where if your company has, this is generally something that I've seen, like if your company has, it's run in a very traditional way, your data teams are like, they do very specific things. It's very difficult for you to expect or update your team to just go to build an AI product internally all of a sudden, right? It's one of those things where it's sort of like a cultural shift too, in terms of how you think about building a company and what you're doing. So there are definitely going to be a few of those companies that's going to take a longer time to evolve into those particular areas. Like for the first wave, and this is what I would generally say, there's going to be waves of how AI adoption takes place. The first wave is generally going to be you partnering with large organizations who are going to help you be AI enabled. The minute they start seeing the ROIs coming in and saying, hey, I'm able to make meaningful impact where they are convinced that there's decent amount of work to be done where they can bring this in-house or they need to grow this talent in-house, that's when you start seeing them trying to build these teams internally. Initially, at least, I see this external organizations working with large organizations until they're able to figure out what processes need to have AI enablement, how is it going to happen. And again, it's a cultural shift. It takes a couple of years for that to happen. And some companies just adapt faster and are more built for adapting faster. Others, we haven't seen the same thing yet.
I think it's kind of like people ask me all the time, like, do you think you're going to get replaced by AI? And like, we have a lot of AI. Like I use Copilot, for, summarizing my emails, and I have like Lexis Protege for summarizing case law that like just pulls from actual law, so it doesn't make it up like ChatGPT might. There's tons and tons of tools, even that like pull from like our Word documents to like add in provisions that I want that make me really efficient, but I'm still not an oil and gas attorney and I'm still not a real estate attorney. So I don't know, like I think the same thing like with programmers, like people that are really skilled programmers, if you give them tools, instead of like, maybe your CFO has room in the budget for 10 programmers, but if you give those 10 programmers tools, rather than like their list of 20 things they can solve that year, they can solve 100 things, but they still can't solve infinite things. And there's infinite things you can solve with software problems. So I don't know.
All right. Well, nobody's giving me the hook yet, so I'm going to ask one more question. All right. So if I'm a founder and I've got an AI startup or any startup for that matter, Gopi and Aileen, what's the best way to get a hold of you, and like how early is too early and how late is too late?
I'll start off. So I think like we work with like founders who haven't even started their companies yet. So I think that's a general rule. Like if you want to find the best people, you have to go early. And that's been our thesis too. Like we have like a separate sleeve just for very early stage pre-seed deals. We've gone all the way to like before company formation itself. And yeah, if you want to get hold of me, like I said, you won't find another person with my name, at least in Austin, so it's pretty easy to do that. Otherwise, it's gopi@ensemble.vc. So yeah, reach me out. Happy to grab a coffee and chat more.
Pretty much the same answer, including the unique name. I would say, like, never too early to meet a founder. We always want to meet them as early as we can and build relationships, because you're getting into a long-term relationship, and I think everyone knows that. But like, this is a marriage. You are bringing somebody on as your partner, especially if it's like Mercury, where we lead deals and we will take board seats. Like, we're going to hang out a lot. We're going to get to know each other really well. So like, let's get to know each other early and decide if this is like the right partnership, right? Too late would be anything probably like post Series A, Series B, because we won't really be able to participate meaningfully. Unique name, aileen@mercury.com.
All right, and similarly, Valeska, if I'm an early stage founder, is it too early to reach out to Perkins Coie?
No, I mean, we do everything from like formation. I would say like, once you start getting traction and you have an idea and you're ready to start incorporating, like we have our Lone Star launch package that like pretty easily puts you guys together and gives you the documents you need. But like, you know, once you start like reaching out and you need a privacy policy and you're starting to negotiate big, like especially if you go to enterprise contracts, like people are going to start expecting you to have something that you didn't chat GPT for those. And we can help you with that. And before you get to the point where you're like getting to a round and like you're, you know, and you get a term sheet, like please call. Like I will talk to my clients off the clock for an hour to like go through their term sheets before they sign on the dot, because I can't walk it back with these guys once you've signed. So I think it's worth the time just to like keep in mind that we're a team, and like, you know, I'll be in the boardroom with them too when I'm company rep, when I'm investor rep, I'm not, but like, we help you guys get ready for all that stuff. So just keep it in mind, like when can we like ping them and reach out, and like what are good times, because you don't want to wait until it's too late.
Reach out early, okay? We take clients, you know, idea stage and whatever, kids out of their dorm room at UT, we don't, you know.
The small little blonde girl, she's starting a company tomorrow.
There you go. All right, so thank you everyone for coming and being part of our panel, and thank you panelists. I think the big takeaway that I got out of today, at least, was that, you know, it's not all about the technology. It's still about people and building solid teams and attracting the right talent and leading that talent. So for Aileen Allen, Gopi Sundaramurthy, and Valeska Peterson-Hintz, I'm Dan Austin. Thank you all so much.
So much. Sorry.
All right, y'all, crowd in. We have one more session. It's probably our most popular session of the fundraising track every year. And this is the last session before happy hour. We'll have happy hour at Antone's today. Not the Capital Factory Antone's, the bar Antone's. All right, help people get in. Feel free to fill these seats too. The speaker seats are open. We have about a half a dozen active VC investors who are about to pitch you at the VC reverse pitch. All right, thank you. We're going to give it another minute. Feel free to take these seats. These are fine if you want to sit there. We got a few seats over here. Yep, feel free, feel free. It says reserved, but they are reserved for you now. Got one right here, front and center. All right, let's do it. Welcome back, y'all, to the VC reverse pitch. If I can get your attention, we're gonna kick it off. All right, y'all ready? Y'all can keep talking, but just please do it outside. We good? Can we get it? Can we stop talking? Can we pay attention? That's right, that's right. Thank you very much. All right, without further ado, we're gonna kick it off. We have 7 investors who are gonna pitch you 2 or 3 minutes each. Take notes, get ready. We're gonna cycle through them, so we'll hand, each investor will hand it off to the next investor, and we're gonna rock and roll. And if you are pitching and you're not backstage, please head backstage now. But without further ado, I wanna welcome Arjun from Moneta Ventures. Welcome, Arjun.
Thanks, Nick. Hi, everybody. My name is Arjun Hegde. I'm the new analyst at Moneta Ventures. I operate out of our Austin HQ, which is just down the street at the Littlefield building here in downtown. I want to thank Capital Factory and Austin Tech Week for throwing this event. I appreciate it and giving us the platform and opportunity to speak with everybody today. I'm really excited. Just to do a little bit of just about me real quick. I'm a Bostonian. I'm a proud Longhorn. I also a Cornellian, and I studied computer science at both those programs. So hoping to bring a technical perspective in addition to the team at Moneta. To go back to talking about Moneta, and I know that's why you guys are here, not me, I kind of wanted to bring up, a history about Moneta. We started off 30 years ago, almost 30 years ago, with our managing partners working together at PwC in management consulting and software, doing mostly SAP implementation. And, they worked so well together, and they were able to really do well in their careers early on, that they decided to become entrepreneurs together. So they were able to scale 2 businesses, 2 successful exits, and that started with Rapidyme to Fujitsu, and they also managed to start their own company, Sparta Consulting, and they sold that to KPIT. So, around 2014, they had a decision to make. They had to decide, what's next in their careers, and part of the observations they made during their entrepreneurship was the underserved markets and how there were some issues with founders being able to get the capital they needed. And so that kind of inspired them to kind of go back into that field and help out. And with their Fund 1 in 2014, they started with $25 million. Now in 2025, we are operating Fund 3 of $250 million. And thank you. And with that, I'll kind of give us some insight on, what we're looking at, kind of our insights, our thesis. And so we are primarily seed to Series A. We like to write $1 to $5 million checks to kind of initiate and co-lead or lead rounds ourselves. We have the ability to kind of go further with some Series B and Series C opportunities as follow-ons or support. And kind of, going forward with our thesis is, we're ever evolving. We try to be as AI native, try to be super involved. We're dual headquartered, one in Sacramento in the Bay Area, kind of, access to California resources as well as Texas, here in Austin and Houston, Dallas, and even LA and California. So the idea is, our thesis is ever evolving. With our founders and our partners' expertise, it's primarily, focused around enterprise plays. But, the biggest idea here is that we are founder-friendly. Inc. magazine has named us the best founder-friendly VC last 4 years, I believe, and that's because, we are founders at heart. We know the struggles, we know the successes and how to do it, and the idea is to help you guys as partners from start to finish. Thank you very much. Appreciate it.
Hello, I'm Sharina. I'm with 8VC. My counterpart, Yair, couldn't be here today, had a counter meeting. So 8VC is an $8 billion firm. We have our headquarters here in Austin, but we also have our other office in San Francisco. And we've been around for about 12 years. We were founded by Joe Lonsdale, who also founded Palantir. We're a multi-stage generalist fund. Our 3 big buckets are defense, software, biotech, but I focus on seed and Series A. Sorry, I've been here for like 2 months, so it's fresh for me. So we don't only invest, but we also do incubating inside of our company. So we've done Saronic and Gallatin, and some of our portfolio companies are Anduril, Palantir, Epirus, and I'm personally with the defense team under Alex Moore. And for the defense team, I dual hat also as an active duty contracting officer. So a little bit about me. We have a fellowship that they do with the DoD directly. And so we bring contracting officers like myself in. And for those that don't know what contracting is exactly in the government, everything that has to do with solicitations, writing awards, administering, anything with CIBR, if you're familiar with it, procurement, all government contracting, negotiating, that's pretty much all I do. And so now I'm here with Venture, with 8VC to do venture capital and also DoD. So everything that there is to know about defense, we know it pretty much because of directly being connected with them. And thank you guys for your time.
Hi, everyone. Happy Austin Tech Week. Happy to be here with you guys. My name is Catherine Moore, and I'm on the investment team at Live Oak Ventures. Live Oak is an early stage VC fund located here in Austin, Texas, and we exclusively invest in Texas-based founders who are building businesses in tech and tech-enabled services. The firm has been around for about 12 years. Our two founding partners, Krishna and Banu, they come out of Austin Ventures, so they have over 25 years experience investing in Texas-focused venture and have built a great team around them as well to support Texas founders and entrepreneurs. We've made over 70 investments in Texas-based founders at this point, with about 45 active portfolio companies right now. And if you do look at our portfolio, it is a lot of B2B SaaS. We're seeing a lot of really interesting AI companies right now as well. And we tend to take a pretty active role with our portfolio companies. So on the term side, we tend to lead rounds, take a board seat, and then on the more important day-to-day, we really want to be that go-to resource for founders as they build their companies. So that's a big reason for our Texas focus too. We like to connect our local networks, our local resources with local founders to really create as much alpha as possible, and have had a lot of good success doing that. A lot of that will look like building out early executive teams, whiteboarding on product, refining go-to-market strategy, things like that. We do invest in companies across all early stages because we have that local Texas focus. We have a bit of a wider aperture when it comes to stage. So we'll look at everything from pre-seed through Series B. Most of our investments end up being that kind of seed and Series A level, but we have invested in a company at inception from a cold email. So feel free to reach out directly with your ideas. And that company did go on to IPO, so a lot of great success there. But yeah, my name is Catherine, and thanks to Capital Factory for having all of us, and look forward to chatting with you guys.
Hello, everyone. I don't think I've ever seen my headshot quite that large before. But very excited to be with you all. Thank you to Capital Factory for putting on this wonderful event. This is only my second time in Austin, but everybody has been so warm and welcoming, and hopefully we'll be spending much more time here. So I am an investor with High Alpha. We are a seed and Series A venture capital firm based in Indianapolis, actually. I started with the firm 4 years ago, spent 2 years in Indy, and have been in Chicago the past 2 years. So I'm our one person there, kind of a satellite headquarters, but we make investments all over North America. Thesis-wise, we're B2B SaaS generalists, so very expansive portfolio, over 80 companies. Some places we've been spending time recently include vertical SaaS and AI, go-to-market tech, office of the CFO and back office, and supply chain and manufacturing. But I would say any B2B software at the application layer is a good fit for us. From a traction standpoint, usually 1 to 2 million in ARR, but sometimes go a little earlier or later. And our check sizes range 3 to 7 million. So in most cases, we're leading, but we can co-lead or write smaller checks in select cases. And we're investing out of our $125 million Fund 4, which we closed last summer. So I've made a handful of investments from that. So now let's shift gears and talk a little bit about how we're different, why you should want to partner with us, which ties back to our founding story. We were founded by the former ExactTarget team. ExactTarget is, or was, an email marketing automation platform that IPO'd in 2012 and sold to Salesforce in 2013, becoming the Salesforce Marketing Cloud. So lots of former operators across the team who have experienced the journey firsthand. We were also founded with an interesting dual charter, one part startup studio, one part venture fund. So not only investing in companies, but partnering with founders at the earliest stages to build and launch new businesses. We've continued to evolve over the past decade, so have raised larger and larger funds. And I would say the studio relative to the direct investing is just a small piece of what we do. It's still a really core part of our DNA, and we think that the model keeps us close to the metal, and we also have a great platform services team that supports the studio as well as the broader portfolio. Culturally, I'd say we're really relationship driven, so maybe that's the Midwest in us. But we love working with founders who are just fundamentally good people, who we like, and who also are really ambitious and want to build big businesses, and also just very collaborative team. You'll have somebody closest to the deal in the company, but you really get a chance to get to know all of us and work with us across the team. So if that resonates with you, please reach out. We want to spend more time in Austin and hopefully make some more investments here. So thank you.
Hey everybody, my name is Matt Saida. This is the first time I'm doing something like this, so bear with me. I did promise myself I would avoid using words like AI, synergy, flywheel, all of that in the first 30 seconds of this, so let's see how I do. So anyway, again, my name is Matt Saida. I'm at a firm here in Austin called Silverton Partners. The firm's been around going on 20 years. We're investing out of our 7th fund today, and in all honesty, the strategy and focus of what we do hasn't shifted in that time. We focus on this community, we focus on early stage, we focus on tech-enabled, we focus on being all-in kind of investors. So we're often the first institutional money in a company. We like to lead seed rounds. We like to lead A rounds in those same companies. So our focus is being more concentrated with the teams that we're investing behind. So that's higher concentrations of time and capital, where we're leading those rounds for you guys, doing all or most of it, and plugging you guys into what I think makes Silverton so attractive, which is, here we go, here it comes, the virtuous flywheel of the magic of what we do. It really comes down to the talent in this community, where we work hard every day to prove to you guys what it means to be part of a successful journey and bringing our perspective to that. And in doing so, we get to grow up with our teams and graduate those founders and executives onto their next journeys as well. So a big part of what we do, our superpower, is bringing in those experienced executives into early stage companies earlier than when you typically get them. I think other things that differentiate us are really like the partner that you get in your business with Silverton. So it's not just the check, it's not just the quarterly board meeting or monthly sync up. It's honestly, it's the early morning, late night calls when you got a question on your brain. So you get a real partner in the business. You guys are in this all day, all night, heads down, focused on what you're doing, and we help be a sounding board for what you guys are working on. So being a real partner in the business, I think, is something that differentiates Silverton. Being that long-term capital, whether it's the seed or the Series A, or investing out of our growth vehicles. We've got a strong track record, again, 20 years of producing top quartile, top decile funds, and a lot of that comes down to the strategy and the community. And another part of the strategy at Silverton that I think is worth hitting on is the fund size. So in aggregate, we're investing out of a $250 million fund between the seed A fund and the growth fund. And what that does for us is we're focused on creating consistent, durable outcomes. And I think that should align with everything that you guys are thinking about here. So we're not just saying hey, you need to be $1 billion outcome or bust. We're not saying you need to be $1 trillion or $10 trillion outcome or bust. It's funny how fast that shifts. We're thinking how do you get to $1 million of ARR in the next year or two? Then after that, how do you get to 3? How do you get to 5? How do you create a durable business all along the way while preserving that optionality to create something that's durable? A few years back, I ran stats, and the high-level numbers were basically like companies that reached a unicorn status in Texas were, they, on average, raised 1/3 as much capital as founders in any of the coasts. So do the dilution math there, you own more of your business. And we're 3 times more likely to be profitable. And that's kind of the ethos that we like to take in helping you guys build businesses all along the way. You guys own more of it. We're backing you guys, the vision, and yeah, and we're doing that with as much consistency as we can. So again, my name is Matt. I'm at Silverton Partners. We like to focus early, and we like to get dirty with you guys. So feel free to hit us up if any of that sounds interesting, compelling.
Hello, everybody. Anthony Marfisi here, associate at S3 Ventures, based here in Austin. Brief background on me: previously worked at a handful of VC firms, recently DCA in Phoenix, and prior to that, Burlington Capital in Omaha. So been in VC for a few years, but ended up here at S3 in Austin. A little bit about S3, a full-time team of 14. Been based here for about 20 years, founded by Brian Smith. He's our managing director. Brian previously was an engineer and took a company public in the early 2000s, and then eventually founded S3 around 2005. So to date, we manage around $1 billion in AUM. We're currently investing out of Fund 7, which is sized at $250 million, primarily investing in B2B software with the balance allocated towards some healthcare tech and med device. On the software front, we're fairly agnostic and opportunistic, so we'll invest up and down the stack from infra to data pipeline and management, some cybersecurity, all the way up to some vertical and horizontal SaaS. Primarily coming in at seed through Series B stages, so think initial check sizes ranging from 1 to 10 million, with the ability to invest well over 20 million throughout the life of a company. Something unique about S3 is we've been backed by a single LP to date across all 7 funds for the past 20 years. A highly philanthropic family with a multi-billion-dollar foundation, and this has been advantageous for us as we don't have to spend as much time fundraising ourselves and can pour that time back into supporting our portfolio, which we actively do, along with the ability to extend our fund sizes over time and provide truly patient capital. So to be more concrete, we have a team of associates, including myself, that actively work with a lot of our portfolio companies, anywhere from FP&A to hiring to kind of board and fundraising strategy. And so I would say we have right now over about 40 active portfolio investments. I'd venture to say we have an active project with about every one right now. I personally run FP&A for a lot of our recent portfolio investments, which has been really hands-on and just working with the founders, helping them prepare for the first board meetings, fundraise capital, et cetera. Something else specific to a single LP structure is we can provide truly patient capital. So what that means is we've had some positions where we've held as long as 10 plus years. For instance, Alchemy Technologies, based in Dallas, is a banking technology company. We invested at the seed, Series B and C stages, and they IPO'd in 2021. We've held that position for well over 10 years and still hold most of our shares today. So we're really in it for the long haul and try to provide active hands-on support throughout the ride. Thank you.
Hi, everybody. I am Carrie Rupp with True Wealth Ventures. We are an Austin-based firm that has been around for 10 years, and we focus specifically on women-led companies that are improving either human health or environmental health. And to define that more specifically, women-led to us means there's at least one woman who is full-time, who's either on the C-level team or the founding team. And I wish that it weren't necessary to have a fund focused specifically on women-led companies, but since we started 10 years ago, the percentage of funding going to all women teams has pretty much stayed at 2%. And so people asked why we needed a specific fund, and I think you need a specific focus to change the metrics. But there's plenty of data that shows that when there are more women in senior leadership, companies outperform. So for us and our investors, it's actually an opportunity. So we are also an impact fund. I mentioned that the companies in which we invest have to improve human and/or environmental health. Turns out that a lot of women who start companies are focused on things that are, improving things that they see in their lives. And a lot of our LPs, actually, you look at the data, and women are twice as likely to invest in companies that are actually looking to improve outcomes. So there's a lot of, circularity there. So we invest at seed. We tend to write first checks of up to $1 million into what we prefer are priced seed rounds where we take a board seat. But we have a decent amount of flexibility at that stage. So we can follow, we can let someone else take the board seat if we know them and like them and trust them. And we can do notes and safes. We'll even bump up a little bit into seed 2, but once you're at Series A, it's just too late for us. So we'd love to get to know any companies that think they might be a fit early. Much like Live Oak, we will take cold intros. We think it's actually one of the problems with the reason that women are not getting funded is that their networks are different. And so we don't want to lock you out from reaching us. So find me on LinkedIn or go to our website. We actually have an easy form for you to fill out to get in front of us, and we give those companies attention every week at our deal flow meetings. We're invested in 19 companies today. A little more than half of those are in health. It is a mix of hardware, software, and CPG. Really for us, we're looking at, is it a venture backable idea, but is it also driving those outcomes that we're looking for? And there are lots of different ways you can do that. So we've got food as medicine, and we've got AI-based spectroscopy that's scanning used textiles to see which ones can be recycled. So really broad range of applications. And I think that's all I've got.
Thank you for the picture. All right, we're going to invite all the investors back up on stage for a quick picture, and that wraps up our fundraising track at Austin Tech Week. So thank you to all of our speakers, panelists. Thank you to Perkins Coie for sponsoring the track. And I hope you all walk away with at least one or two things you learned. Join us tonight at 4:30, about a half hour, 45 minutes from now at Antone's down the street, not up the stairs. And that's for happy hour sponsored by the Consulate General of Canada in Dallas. All right. Thanks, y'all. Thank you to our investors. Hey, Steven. Nice to meet you.